similar to that regime.
Okay, well, it looks like that regime, we had a May that John mentions was flat, flat, flat. Is it giving you a direction? Is there a bet within the equity market, and particularly within derivatives, that signals some form of June, some form of bet for June?
Well, I think what we've seen over the last week is very much a bear market rally or a dead cat bounce. What we've seen in terms of the price action, the laggards in the last month or so in this sell-off have all outperformed. It's really been a mean reversion trade. We've moved into month end, and we think there was some decent buying pressure that supported the market, and we now find ourselves in a little bit more no man's land. What we think is going to drive the market forward over the next coming week and over the next coming month, whether that bear market rally will turn into something more sustainable, is exactly what you were talking about just before I came on the show, and that's the macroeconomic data.
So, Greg, it sounds like you agree with both Citi and Morgan Stanley in saying that basically the valuations have to continue to re-rate downward, that we are not done with this repricing. Is that correct?
No, I don't necessarily think so. I think we're in a regime that I would describe as very much a bear market regime. But I think it's been driven by two things. One is an extreme multiple compression that we've seen this year. The type of multiple compression we've seen on the S&P PE, we've only ever seen in a recessionary environment. So our view is that we're in this kind of bear market environment, yet we haven't seen the recession manifest in the macro data yet. So we still think there's a path for the US economy to have a soft rather than a hard landing. And in that type of environment, P multiples, although they're not cheap in absolute terms, we don't think are expensive enough anymore that it's necessarily going to prohibit the market rallying from here. So we think if the macro data comes in a little bit less bad than people are anticipating through the second half of the year, that could actually set us up for an equity market rally.
So do you think that it's good to position for that, given the uncertainty, given the wide band of potential economic outcomes and, frankly, earnings as well?
I think it's incredibly difficult to have super high conviction on where the market is going to be on a 1 week or a 2 week view. But over a medium-term view, we think the retracement that we've seen year to date is more than justified by the economic data. So if we do have the data improve, we think it sets ourselves up for certainly some of the more cyclical parts of the economy and the market to perform. So we think the current spot levels for the equity market could remain choppy, but ultimately we think we end the year higher than where we are now.
I mean, Greg, I love the idea of a dead cat bounce, and of course that's written up at BNP Paribas as rebound du chat mort, or something like that as well. Mm-hmm. It's a phrase we hear a lot, and it's a cheap phrase, but you're a grizzled pro. Describe for us the symbolism of a rebound du chat mort.
Oh, please.
Thank you, Tom. I think the thing which most obviously characterizes this is a lack of new leadership and more just a mean reversion trade. So when you look over the last week, when the market has had this bounce, you look at what has led the market, what has lagged the market, it's the exact mirror in terms of price action of what we saw in the prior month. So I would look for two things to confirm that this is less of a dead cat bounce and more of a sustainable rally. Mm-hmm. One would be new leadership, so actual constructive moves from stocks driven by better data. And the second thing we'd look at is a further normalization of the volatility market. We'd look for that VIX spot level to come back towards the low end of the range.
Okay, this is really important. Give me a VIX level that you've got your eye on here. We're at 26.33 right now. I watch this like a hawk like you do. Give me that level that signifies the end of les rebonds de chat mort.
I think if we move lower from here, so we view the lower end of the likely range that we could trade in the VIX to be around 20. We don't see us moving back into a high teens.
Mon Dieu.
2-0. We don't see us moving back into a high teens regime or a mid-teens regime very soon, but we do think we can get to the bottom end of that range around 20, and we do think that would be a good signal that we could be in for a period of more comparative calm.
Greg, I give you incredible credit for maintaining a straight face, as Tom Keene butchers French. I do wonder, going forward, what you see as the dichotomy between retail positioning and institutional positioning, something that you've picked up on, and say that it indicates perhaps more of an unwind in specific names. Tell us about it.
Yeah, I think that's a great question, Lisa, and it really comes to the core of our thesis of what we think could out or underperform through the balance of the year. You know, when we look at equity markets and what drive them, as I said, macro data is important, valuations are important, but ultimately it's positioning and flows that really moves the market. When we go around and speak to a lot of institutional accounts, we get corroboration of what we can already see in the data. The hedge funds have degrossed, asset managers have put cash on the sidelines. Now that is at odds with the picture that we see in retail positioning. In retail positioning, we still think that there's a lot of excess in the market. Now the interesting thing about that is those two pockets of investors have tended to be concentrated in different areas of the market. So retail have been much more concentrated in some of these more euphoric, ultra-high growth stocks that have already been underperforming, but still look expensive relative to value stocks, and we think that rotation could have much further to run.
So, Greg, I was actually immediately looking at GameStop, and it's down more than 15% and down ahead of the market. Does this matter to the broad overall averages, or is this just noise on the peripheries?
No, I think any single stock, particularly a smaller or mid-cap stock, is noise around the edge. Now, we can take a signal from what those stocks are doing more collectively. We put a basket together back in November called the Cappuccino Basket. This was BNP's play on the frothiest names in the market. We've seen that basket half over 5 months. So taking a collection of these smaller idiosyncratic stocks that are not necessarily any one of them going to move the needle, we think is a much better way of looking at it than focusing in on one single name.
Did you say the Cappuccino Index?
The Cappuccino Index, the frothiest names in the market, Tom.
What are you going to do with a basic call here for the equity markets? Away from a Cappuccino Index, is it just about profit and free cash flow forward?
Yeah, I think the best single metric that we can find for timing equity markets is earnings forecast revisions. So whenever analysts are putting through upgrades or downgrades to their forecasts. What we've seen this year is those downgrades have been very concentrated in the growth names. So when you look at the earnings momentum for the NASDAQ, it looks pretty poor. When you look at the S&P, it looks more reasonable. When you look at something more cyclical like the Russell 2000, it actually looks pretty okay. So that's one of the gauges we're looking for. When we move into the next earnings season, that's going to move the needle again. But to the extent that we see better earnings momentum in some of the cyclical names, this is one of the things that is giving me a little bit more comfort that maybe we're heading potentially towards a soft rather than a hard landing.
I'll tell you one thing, Tom, no tickets for us for Roland Garros after that.
Got that right.
Greg Bowler, thank you, of BNP Paribas. Johnny Filion is not going to let him on this show again, Tom.
I thought
you've been practicing your French.
I don't know if I was practicing my French, but our love of cats is so sensitive.
Of course. Last time we did this, Tom, the cat mafia called in. I'm not going there.
The cat mafia.
Got nothing to say about cats.
Let's talk about the French Open. Exciting, huh?
Rafa Nadal. Tom, I get so emotional watching Nadal that I can't even watch him play tennis.
Admit, I play dumb, but
deeply invested in that guy. Just phenomenal. And the smile on his face yesterday at the end of that game against Novak, just joyous, Tom.
He's not a young guy in that heat.
No, he's not.
You know, it's something.
And he was upset that they had to play so late as well. I saw a headline, Tom, that the game started in May and ended in June. Went through midnight in Paris. Just unbelievable, and good luck to him in the semi-final.
Well, we'll see there. Like, you know, he's got semi-final, so he's got to play the semi-final, then the final, right?
Yeah, and that'll be number 14 at the French, Tom.
Very good. Okay. Well, we'll have to see on that as well. I see a mixed market. We're sitting here on the data, John, and I'm going to go back to the data this morning, John, and I think that just within all the turmoil, it's not another June 1st. This is some data that matters, as you mentioned, the jolts later.
ISM data, to what degree will we see some form of deceleration? Here, Lisa, in the ISM a little bit later, then on to jolts after that, then on to claims and payrolls through the rest of this week.
It's so noisy. I mean, all of the economic data points have had less and less significance as it really just all adds up to a sea of mush. But I do think I get your point.
A sea of mush.
A sea of mush. I was, having breakfast in London. Honestly, I do think that jolts is going to be...
Did you just call breakfast in London a sea of mush? Is that what that was?
No, there was a lot of...
Lisa.
I actually really enjoyed it. It was like I had avocado toast.
Right before the Queen's Jubilee, you're calling English breakfast a sea of mush.
Oh, come on. The Queen's got, for the lunch there, she's got to have a full English. It was with
love. I like mush.
Do I get tomorrow off and Friday?
You get an extended bank holiday.
Do I really?
Yeah.
So I don't have to come in tomorrow or for payrolls. Awesome. Futures unchanged on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the US President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 15 miles away. The US says Ukraine has promised not to attack targets inside Russia. In the UK, consumers are being urged to brace for inflation getting worse before it gets better. The British Retail Consortium says that fresh food prices are now rising at their fastest pace in a decade. It says fresh food rose 4.5% in the year that ended in May. China is planning for years of COVID zero, with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. The richest person in the world doesn't appear to be thinking much of working from home. Elon Musk apparently sent an email to the executive staff at Tesla with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. And the new Top Gun movie had the biggest ever theatrical debut for a Memorial Day weekend. Paramount's Top Gun Maverick brought in more than $160 million worth of ticket sales in North America through Monday. That lifted the spirits of movie theater operators hoping to bounce back from the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence. They have a laser focus on addressing inflation, just like I am.
The President of the United States saying respect the Fed, sitting alongside Chairman Powell. Tom, what did you make of this? It was a little more elegant than the former administration, but ultimately making the same point, isn't he?
Yeah.
In just a more subtle way.
Exactly.
Respect the Fed. I respect the Fed, but
well
it's
said.
their job, not ours, to sort this out.
I thought, for pros on the street, it was a colossal non-event. I thought it was timid. I thought it was tentative. And the differences, and John, you were talking about this on the break when we weren't talking about Nadal, and that is that there's a difference of relief from inflation versus moving the needle of inflation lower, as we'll speak to Adam Posen here later.
Well, Tom, that's a point you've been making too. So just elaborate on that a little bit more, what we can do about inflation to bring it down and how we can provide some relief to consumers who are getting really squeezed right now.
I mean, take the giant of Brown University, William Poole, and all of his public service. It's real simple. You've got a monetary solution and you got a fiscal solution. In an election year, the fiscal solution is just flat out. You're not going to do a fiscal contraction to slam a nation into recession. So you're on the monetary side, a la Dudley, and what we're arguing about is simply the speed to get there, to get to some form of there, understanding that there's a complete mystery on rate rise.
Over to you, Chair Powell, Tom.
Yeah,
bottom line.
We'll have to see, and I don't know. I'll leave it to Emery Horton to tell me about it. I mean, she was more focused on K-pop than she was on that.
So
meeting.
were you, to be fair, Tom.
Expert on K-pop, teaching a course there Wednesday nights is Wendy Schiller at Brown University, director of the Taubman Center for American Politics. Wendy, I want to talk about one-term presidents, and of course, I'm being bold here and suggesting maybe Mr. Biden, like Mr. Trump, is a one-term president. What do the last 2 years of a one-term president look like?
Well, obviously, Tom, you're pointing out a sort of speculation right now, two fronts. One is, what kind of Congress do you work with? Do you work with a narrowly controlled Democratic Congress or a narrowly controlled Republican Congress? And we don't know that yet. So we're going to have to wait and see. Presidents tend to look towards executive orders. They tend to try to do things to get around Congress when they have that circumstance and do as much as they can through the executive chain rather than the legislative congressional chain. There's also going to start to be a bit of a free-for-all in the Democratic Party if it becomes clear that either Biden doesn't want to run or can't run or, will step aside. Right. Then you've got those dynamics which will get very, very messy pretty quickly when those signals appear.
Wendy, years ago, you sat with me at the bar at the Black Pearl in Newport, Rhode Island, and you said, Tom, you got to read your Alan Nevins. So I read my Alan Nevins about the 1890s. To me, it's a lot like the 1890s pre-Teddy Roosevelt with huge polarized America. Is that close?
You are spot on, absolutely right. If you look at the levels of polarization, and people do these figures all the time, the gap of polarization and division was as high as it was then as it is now. The difference is the range of issues is so much broader, right? The government does so many more things that we are divided along many more dimensions than we were then, but they were still very divided. And the parties were in flux, particularly the Republican Party was really a mess in the 1890s and the 1900s. So we're going to have to see if the Republicans can get out of their own way moving forward. So Biden may have not as difficult a time, theoretically, if the Republicans are divided amongst themselves. And that's going to depend on the big T, meaning Donald Trump. How much does he intervene? How much does he pressure members of Congress once they win the majority? If they win the majority, you've got terrible economic conditions, I think, for the Democrats, you rightly point out. But there are other issues on the horizon. Gun violence, sadly, is very much present again. And, of course, we have abortion. So these can mobilize constituents that didn't vote for or who the Republicans were already counting on. And it raises levels of uncertainty going into November.
Wendy, if you were advising President Biden on how to rearrange his staff and how to position best heading into the midterm elections and frankly out of them, what would you recommend?
Well, he's got a Commerce Secretary. I'm a little biased. She was the governor of Rhode Island, and I'm from Rhode Island. But she's good. She's good in crises. She's good on TV. And she got national attention handling COVID in our state. So if you can get that kind of attention from a little state like Rhode Island, think about what you could do on the national stage about the economy. So he's got to put more of his cabinet members out front, which, Obama didn't do either. And so you have to think to yourself, you've got some stars, people that can help you, get them on the road and get them out there.
Professor Schiller, we saw Secretary Raimondo in Davos. She was wearing a Browns men's hockey T-shirt. She was like exercising, getting in a couple miles.
Well, she didn't go to Brown, but she got along well with Brown.
She financed it.
Thank you, Tom. Wendy,
I didn't go to Brown either, so.
Yeah, but she financed it.
But Wendy, your view here is actually exactly counter to a lot of what people are saying, which is to actually get rid of cabinet members. You're saying push them forward more, make them more visible, make it less Biden focused. Talk a little bit about how unpopular your view is and why that might work.
Well, I have been advocating staff change on the communication side for Biden. And Psaki did a good job for a while, but it was time for a change. We'll have to see how that change works. But the general infrastructure, the staff that's advising him, he's got a lot of long-time people. He's very loyal. He's been around a long time. But you need people with a fresh perspective, people who are on the ground, newer people, younger people, perhaps, not to be ageist. But you need to, I think the internal staff, I think the circle of advisors has to change. And the communication staff, I think, has to ramp up better. But presidents don't like to do this. They finally got there. They want to run the show, understandably. But then you're Jimmy Carter. And that didn't turn out too well.
Is Joe Biden Jimmy Carter?
Well, in the sense that he knows a lot, right? We know that he's been there a long time. He's been in the hot seat. So and he's with it. People claim he doesn't know what he's doing. I don't think that's true at all. So, he's got to let go a little bit and let the people who are the next generation, who are good, who've proven to be good in communications in his cabinet, out the door and send the message out that the Democrats are better in economic crises than Republicans, which history shows to be true. We're not hearing that message at all.
Wendy Schiller, thank you.
It's great.
Wendy, great to catch up, as always. Headline just caught my eye. Just want to bring it up just quickly. A financial services company, S&P Global, suspending guidance for 2022 on macroeconomic conditions. Lisa, if that doesn't tell you a lot, I don't know what does.
I mean, this is a company that literally tracks other companies and their earnings.
Literally, that's what they do.
Literally, that is what they do. And they have no clue. So that tells you everything you need to know about how difficult it is to get any visibility right now whatsoever.
Unbelievable, Tom, just to read that headline.
I've never seen that. That's extraordinary, John. You're absolutely right.
Isn't it bizarre?
The times are bizarre. That's perfectly said, but it's not S&P Global that's bizarre. It's the times we're living in. The math of this, John, way out on the right side of the equation is an epsilon, a Greek fancy letter that means we don't have a clue what we're doing, and that epsilon now is original.
Isn't it your job, though, if you're S&P Global, to have a clue what you're doing on stuff like this, Lisa? How many examples of this have we seen now?
Yeah, and they talked about significant deterioration in macroeconomic backdrops. I wonder how much read supply chain disruptions, the issues in China, the prices of some of the materials, but also debt issuance, right? Because they rate debt issuance. And the unclear aspect of how much debt companies are going to want to raise, given how much higher interest rates are, is a big wild card for not only the S&P, but also for big banks.
A little bit awkward the next time you put out a rating, isn't it? On a country and your own company.
We have no idea.
Can't provide any guidance on the future. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the Fed is very aware that the U.S. economy is already showing signs of easing, that we're already seeing cracks in the armor.
Companies are still able to pass costs through. But again, as we reach higher and higher price levels, that becomes more difficult.
There's this frustration with where policy is headed.
Tightening will get us down to about a 4%, but getting down to a 3% probably is going to engineer a recession.
The reality is, I don't think they're going to be able to raise as much as markets have priced in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures just about positive, 0.01%. TK, new month, same problems.
New month, same problems. Deceptive market today. Really, John, just to churn to the market. We don't even need to go into it. We'll do a mini data check here. To get to the major call, John, which is what happens not in this June, what happens in July? What happens in August? Complete, total mystery.
And Tom, how do we reset in September? September 21, that's the date in your diary, the date in so many people's diaries. What happens when this Fed gets around a table? They hiked 50 in June, they did it again in July. What's in store in September?
What's in store is the data's going to be there. And by that time, John, corporations are going to really begin to adjust to the cards dealt to them. And I'm not predicting a massive cost cutting by corporations, but it's got to be in their mind, and particularly to speed up their rationalizations of 2023.
Because right now, Bramo, these corporations are struggling to get any visibility on the future.
Yeah, you pointed out this headline, and I'm actually just sitting here thinking about it. The S&P Global, this company, suspending 2022 guidance on macroeconomic conditions. Basically, they have no clue. Their job is to rate companies. Their job is to actually have visibility into a corporate activity and what is going to happen ahead. They have none. What does that tell us about how much visibility there is? And then how does the Fed arrange on this, which is the reason why so many people think that ultimately it's whatever way they decide to shift that's going to determine the path of the markets, because everybody else just sees a whole slew of mush.
So many people are getting caught wrong-footed. We've seen it corporation across corporation, industry across industry, of corporations and leaders, policymakers struggling to gauge where demand is going, Lisa, and struggling to recalibrate their company to have the appropriate level of capacity to meet that demand. And we've seen that repeatedly over the last 12 months and over the last few weeks, mistake after mistake after mistake coming to the surface.
Capacity with respect to goods and capacity with respect to employees. And I think this is important. It's the reason why we're watching that JOLTS data that comes out later this morning. How many job openings are there? When do companies start to pull back on their employment because they don't want to be caught wrong-footed, overly employed, paying people higher wages at a time when there is such fluctuation in terms of the macroeconomic conditions?
Well, Elon Musk has a plan, Tom, over at Tesla. Remote work is no longer acceptable, Musk says. Anyone who wishes to do remote work must be in the office for a minimum, and I mean minimum, of 40 hours per week or depart Tesla.
This is a tinderbox, John, and I don't know which way it cuts. I don't have any wisdom on this at all, other than senior officers running out of patience seems to be the rate of change here.
Do you remember this time last year, Tom? Do you remember get back to the office by Labor Day? Labor Day. Enjoy the summer, because in September it's back to work. What happened?
It didn't happen. I mean, in the Midtown Manhattan folks who were located, it decidedly did not happen. I don't know what your story is. Tell us about your story. John, do a data check here and save me right now.
Before people tell us about their stories, and phone in. We should do a segment on that. Phone in from your trading floor and tell us about your story.
And speak French.
And do it in French.
Damien Sassauer can phone in from Turks and Caicos. It works.
Futures positive about 0.05%. Really flat month through the month of May. Kicking off June with more of the same. Yield higher by a couple of basis points. Bramo on a 10-year, 286.22.
This is what we're watching today. Quantitative tightening supposedly starts today, formally anyway. It doesn't actually start until June 15th, when about $15 billion of treasuries rolls off, comes due. How much can they get the balance sheet down, a $9 trillion balance sheet, at a time when a lot of people are expecting this to have a bigger influence over markets than many people have priced in? 10 a.m., I'm watching this because the Bank of Canada, frankly, has been a sort of precursor to the mood in other central banks around the world. They're poised for their second 50 basis point rate hike at today's meeting. This comes on the heels of record CPI, like we've seen all over the world, but also in Canada. Do they get more aggressive? Do they stay more aggressive? Do they indicate they will remain so going forward? And what does that mean for the Fed, for the ECB, especially as the hawks start to get louder? And today, talking about hawks getting louder, we hear a slew of Fed speak, including New York Fed President John Williams at 11:30 a.m., St. Louis Fed President Jim Bullard at 1 p.m., also, the former New York Fed President Bill Dudley joining us here on Bloomberg Television in about 45 minutes' time. John, you talked about that JOLTS data, the job openings data. How much does it start to come down? We have nearly 2 job openings per unemployed American. How does this actually trickle out into a labor market that, by all accounts, is overheated, by all accounts, isn't really getting that much better? And that is a big concern, clearly, for the Federal Reserve.
It's this perfect picture this Fed's trying to paint, and ultimately trying to realize, and Lisa, it's really difficult. You've got to bring down job openings, take out some demand, some heat from this economy, rebalance the labor market without seeing unemployment go much higher. That's a tough, tough job to try and execute.
Which we will hear from Bill Dudley about how to be realistic and what realistic guidance from the Fed might look like. I'm sure he'll have a lot of things to say on that.
Looking forward to that. Joining us now, Stuart Kaiser, the head of equity derivatives research over at UBS. Lucky to have Stuart with us in a studio. Stu, let's start here. Big squeeze last week. You called it a low conviction rally. Talk to me about how you saw investors using that rally to reposition, readjust, and protect themselves once again to the downside.
Yeah, great. Good morning, Jonathan. Yeah, and that is how we termed it, I think, mainly for 2 reasons. One is that, during the rally, we just saw investors adding to hedges. So put open interest rose pretty considerably across most U.S. benchmarks, across U.S. home builders, and in the retail sector. So it did seem like people were using a higher price point to kind of reset hedges as the market moved higher. And then secondly, frankly, it was just a very low volume rally. So there wasn't a whole lot of participation either in the option side or in cash market. So it certainly seems like either folks are out of the office or they were just using this as an opportunity to kind of reset their protection.
Stuart, what does that mean for the NASDAQ move that you've been waiting for quite a while now, over the last few months?
Yeah, I think what it means is you've really hurt sentiment, over the course of the last 3 months, and it's going to, take a preponderance of data to get people more engaged in the market. We think that's underway. You've had 2 CPI and now 2 PCE prints that we think look relatively positive for our inflation outlook, which, calls for a pretty significant decline in inflation, over the summer. Inflation break-evens are lower, rates have come in a bit. So I think all of this is incrementally positive, but really it's a critical mass issue. And I think for investors, we haven't, reached that critical mass. forecasts, and folks are still focused on recession risks if the Fed needs to aggressively tighten. And until we see, again, a critical mass of inflation data, I think the market's going to be pretty cautious about executing that view.
I heard a little sigh as you spoke, and I'm wondering how difficult it is right now to be a bull.
It's not easy, but I mean, if S&P can get rid of their guidance, I guess I can get rid of mine too. So that'll make it much easier for all of us. Look, it is very difficult. I think we viewed this as kind of a three-step process, and we're in step 2, which is essentially accumulating enough data and evidence that you can be confident that this decline in inflation is underway. It's going to take some time, and with sentiment as negative as it is, you're also overcoming kind of the animal spirits, aspect of this as well. So it's been difficult, but we're trying to stay close to home, which is focus on the fundamental data. And we do think that data is moving in our direction, albeit relatively slowly.
Well, how do you even look at the fundamental data? You mentioned S&P Global, so let's go there, right? Suspending 22 guidance. What's notable, as Marty in the newsroom points out, is that they just gave guidance on May 3rd. So that indicates that in just a span of about a month, things changed so rapidly that they withdrew it. What does that mean in terms of what you should be clinging onto and how to interpret data that's already dated by the time it comes out?
I think it's a great point. I think the same thing happened to Snap, if I remember correctly. They posted guidance and then quickly kind of, shortly thereafter cut it as well. It's really difficult. I think, honestly, the confidence intervals around these forecasts are incredibly high. I think that applies to us and for the Fed as well. I think you need to track the high-frequency data as much as you can. And really, I think, to us, it's identify the signposts you're tracking and really kind of focus on the data in that way. And, from us, from an inflation perspective, that really gets back to wages. So it's looking at, composition-adjusted average hourly earnings. It's looking at, kind of core services and really keeping a close eye on what that is, because we think that is kind of one of the key signposts to matter. So I think, look, the data is going to be volatile. I think you need to identify a few signposts that you're comfortable with, that you think are going to ultimately determine the outcome, and follow those, frankly, as closely as you can, and not listen to the radio too much, I guess. I don't know.
Well, be careful what you say there, Stuart. Did he say that? It's not my fault, Al. I'm sorry. Okay, Stuart, I want to talk about the easy move on pandemic inflation from 8% down to whatever percent. How do equities respond when we get to 5% inflation?
Look, I think the process of getting from 8 to 5 is going to be very, very positive for equity markets. I think the question,
then what?
That's the big question. That's the debate we're having with investors. It's not necessarily whether it's peaked; it's the rate of decline and what level it kind of settles at. And we think it's going to get back into the 2 to 3% range on core inflation by the end of this year, and that's on a year-on-year basis. But to your point, if we get into the 4 to 5 range and it looks to be stalling out there, I think that's actually quite a negative outcome for equity markets, because then the Fed is going to have to probably slow demand materially. So the debate really is rate of decline and what level we settle at. And in either case, though, I think there is a tradable window there. If you go from 8 to 5, I think risk assets will respond positively. If you think we're going to settle at 5, then that window is shorter, and you need to approach it maybe using options in a more risk-adjusted fashion. If you think we can get down to 3 or 4, then I think you can run more risk.
And John, I don't know. It was Stuart Kaiser on radio and television.
Turn it down, apparently. Tom, is Stu allowed back? So. I think he is.
Yes.
Stuart Kaiser, UBS. Stu, great to catch up, buddy. As always. TK, I think Mohammed mentioned this with you guys last week, just the potential for a stop-start from this Federal Reserve, that even if they do have to pause in September, ultimately, to Stuart's point, if you settle down at 5, you've got to go again. And you've got to go again.
And what's important, what Mr. Kaiser said there, was the idea of core versus top-line inflation. The media is focused on 8%, 7%, all the ugly numbers. Core is 6-ish right now. That's still way too high. But what does core do if it gets to 4?
I'm just looking at the estimates for next week for headline. June 10th is when we get that read on CPI. 8.3% the previous read. Survey at the moment, there's only 4 estimates in so far. 8.2%, so far still with an 8 handle. And Morgan Stanley with a pretty punchy estimate from Morgan Stanley too. We'll get into that in just a moment. Futures are positive on the S&P by about 0.1%. The Nasdaq just about negative by not much at all, and yields are higher by 3 basis points, 287. From New York City this morning. Good morning to you all. Kicking off a month of June with a flat market.
On radio.
This is Bloomberg.
On television.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Treasury Secretary Janet Yellen says she got it wrong last year on inflation. Yellen made the admission In an interview with CNN last year, Yellen predicted that elevated inflation wouldn't pose a continuing problem. Now she says she didn't fully understand the circumstances. Meanwhile, the Federal Reserve is about to deploy a second tool to curb inflation alongside higher interest rates. It will begin shrinking its $8.9 trillion balance sheet. Officials don't know how effective that will be. They say it should cool price pressures by tightening financial conditions. And the U.S. is ramping up military support to Ukraine. President Biden says he'll give the Ukrainians advanced rocket systems and other weapons that will allow them more precision in attacking Russian targets. The weapons will let Ukraine hit targets as far as 50 miles away. The U.S. says Ukraine has agreed to not use the weapons to attack targets inside Russia. The city of Shanghai reported its fewest coronavirus cases in 3 months. That came on a day when residents celebrated an end to mandatory home isolation for most of the city. Shanghai saw just 15 new infections Tuesday. That's a dramatic drop from the peak of more than 27,000 a day in April. And Deutsche Bank has replaced the CEO of its DWS group hours after a police raid at the asset management. Ashoka Woman will be succeeded by Deutsche Bank executive Stefan Hoops. The raid had to do with allegations that DWS made unsupported claims about ESG investments. Global News 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
We have unique economic strengths, which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well.
Brian Deese there, the director of the National Economic Council, on the moment we're in right now. Futures on the S&P positive by 0.13% as we kick off the month of June, closing out May with a really flat market, positive 0.01% over the month. Yields are higher by about 3 basis points on a 10-year, 287.31. No drama here. Euro dollar 107.14, negative 0.2%. Some drama here for next week, Tom. June 9th, with the ECB decision just around the corner.
Yeah, the ECB decision is there, and part of it's commodity-based. And, John, you know, Brent crude 117.30 after the fireworks yesterday is still, to me, elevated from where we were X number of weeks ago. And I noticed, John, Newcastle coal down in Australia, not out to new highs, but breaking higher again.
We were whipsawed yesterday, Tom, by that report in the Wall Street Journal that maybe OPEC ditches the plus and goes without Russia and ultimately goes forward and does some kind of production deal without them.
Yeah,
what do you make of that? I mean, the market completely turned around on it.
Yeah, I just think it's noise, and, you know, there's OPEC noise, and we all need to do, I think we need team surveillance in Vienna again for their next 20 minutes.
It's noise, but you want
to
finance a trip and cover it.
You know,
okay.
Team coverage. But when I look at it, John, to me, it's just we're sustaining here nicely above 100 a barrel.
But one number matters, Tom, and it's not that one. And Anne-Marie puts it out every single morning now. It's the average price of gas.
AAA unleaded there, breaking out to new highs yesterday. We'll see what the quote is this morning. Anne-Marie Horton joining us now, our Bloomberg Washington correspondent. Anne-Marie, I want to go to the actual policy now. And we see in China moments ago an $800 billion infrastructure, whatever. I don't know what it is. It's $120 billion U.S. supposedly. I don't know what it is. Where is the fiscal impulse of this White House? That's one thing they can do, is heat it up a little more into the election. Can they?
Well, Congress would have to help them act, right? And so far, this administration hasn't been able to get even every single member of their own party on board. I'm talking about some of the provisions that they want to do when it comes to the the Build Back Better proposals. Potentially before the midterm elections, you could see movement on maybe prescription drugs and also some climate provisions. But that big package we were talking about this time last year, that's not happening before November.
Are the senators from West Virginia and Arizona, are they diminished in power as we go into the summer, starting this June?
I actually would argue that potentially they have more power in these final months, that they are likely going to wield this power that they probably potentially may not after the midterm elections if Republicans are able to snag a few more seats. So right now, really, their positions have a tremendous amount of power because it's the 11th hour for this administration this summer to try to get anything done that they can only get done if they have every single Democrat on board.
Anne-Marie, what a busy couple of days for this administration. Let's go through it piece by piece. We had a report from NBC News yesterday that the president was becoming increasingly frustrated by those around him also, and wanted to sharpen the message. We've had an op-ed piece in a Wall Street Journal on inflation, in the New York Times on foreign policy, a mea culpa from his Treasury Secretary, and a meeting with the Fed chair where it felt like it was more of a it's them, it's not us kind of scenario over inflation. What do you make of what's transpired over the last few days?
Yeah, that was a bit of a pass-the-buck photo op, and then Brian Deese only came out to reiterate that message that this is the Fed's problem. We know that the White House aides have told us that they are making this concerted effort in June to refocus and talk about the economy, because this is the #1 issue that is really starting to hit them very badly in the polls. I believe it's the earlier poll this month from Washington Post. It was 9 out of 10 do not agree with how the administration is handling the economy. And the biggest issue, of course, is inflation, consumer prices. And talking about that NBC poll report, Jonathan, and also some stories in Politico, this is something the administration focuses on. Like every day, I check gasoline prices and I tweet about it. This is what Ron Klain does as well when he wakes up. And it doesn't matter what the administration puts out in the New York Times, in the Wall Street Journal. If you have a car or you're walking on the street in America and you pass a gas station, that is advertised every single day.
Anne-Marie,
the price of per gallon.
So let's end where we began with this report in the Wall Street Journal about the potential for OPEC Plus to exempt the Plus, Russia, basically, from some of the production targets. Basically, a nod to the United States, to European nations, by Saudi Arabia, saying, you know what, maybe we will kick up production substantially to offset the fact that Russia is decreasing its presence on the world oil stage. How significant is this, and how much does this have to do with the trip of President Biden to the Middle East?
Two things. One, I would say that Saudi and Russia are still definitely working together. You have Sergei Lavrov in Riyadh today. So I think that speaks volumes about where the crown prince and the kingdom view their relationship as well and want to keep that relationship with the Kremlin. But if this is to be true and the plus part of OPEC Plus starts to diminish, I'm not sure if so much of this is the Saudis really trying to make sure that they're falling in line to what the United States and maybe other consumers wanted, even others saying that how can you do business and have this partnership with Russia given the war in Ukraine. If they don't have the oil and they cannot export it and they cannot reach their production limits, then what does the New Deal become? Saudi and the UAE, the only two that really have the spare capacity, it's inevitable that they're going to have to step in.
AMH, thank you. Down in D.C., outside of the White House. Anne-Marie will catch up a little bit later. Big turnaround in the oil market yesterday. If you're just tuning in, crude pushed 120, 119.98 at the highs. Then off the back of that Dow Jones story, Tom, big turnaround, 116.22 right now on my screen.
Yeah, it's very, very volatile, and you follow it technically and the rest of it as well. But John, I would also look at the blended indices. I think it was you, John, that mentioned copper yesterday as well. I got to be honest, I'm watching copper more than anything.
Well, Tom, I give you credit to bring up China time and time again over the last few weeks, pushing that through the commodity market.
I'm sorry, this is a huge deal as Shanghai comes out of lockdown. We learned from Leland Miller, it's one big mystery. It's like S&P Global and macroeconomics. Nobody really knows. I think people understand. I'm a Pacific Rim optimist on this. I think they're going to come out and you're going to see a boom, boom, boom.
Again, Tom, what do you make of the leadership, though? Do you think that we've got the support for President Xi right now? Because I can't get any clarity, visibility on what's going on any of those topics.
I'm going to defer to international relations specialists on that. I listen most closely to Elizabeth Economy of the Council on Foreign Relations.
Brent crude 117, WTI 116, a turnaround in this oil market as we start to think about China and demand clicking back in, and maybe the potential for OPEC to do something they haven't done in quite a while, have a meeting longer than 15 minutes. Futures on the S&P up about 0.1% on the Nasdaq 100. We are unchanged. Euro dollar 107.11, negative 0.2%. From New York, heard on radio, seen on TV. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
After all the choppiness we've seen over the last couple of weeks, this is pretty muted stuff so far. Tame. Futures positive by a little more than 0.1% on the S&P. On the Nasdaq 100, totally unchanged. The story for the equity market over the last week, massive squeeze. Big move higher by more than 6.5%. Stuart Kaiser of UBS about 20 minutes ago calling it a low conviction rally and pointing out, highlighting how investors use that rally to add downside protection. For the equity market for Citi, we talked about it already this morning. They don't think we've seen a bottom. They don't think we've seen a high in Treasury yields. Let's talk about this bond market, 2s, 10s and 30s, and focus on the 2-year, as the 2-year yield came in last month by about 15 basis points. 257.88 right now, up about 2 basis points on a session. Not just about the Federal Reserve here for the bond market, but also about the ECB, with Deutsche Bank talking up the potential for a 50 basis point hike from this ECB, Tom. Maybe not in July, but later in Q3.
So they do that. What happens? What happens the morning after?
The morning after where? To markets,
they raise
to the
50
FX market.
beeps.
They get back to zero, Tom, on the depot rate potentially. That's a big turnaround. We've been in negative territory since 2014.
I agree, but I just think it'll be good. It'll relieve uncertainty.
Do you think it will be good if we start to see the economic data go down? That's the problem the ECB has, Tom. It does not have the economy the US has.
That's true.
In the Eurozone.
Fair.
That backdrop for growth in Europe is really fragile. Does not have the strength in the labour market that the US economy does either. It's a very, very different scenario, Tom, I think.
It is. I'm just trying, John, I'm just trying to get a road
Janet
trip to Vienna, and then on our way we'll stop at Frankfurt for ECB.
So Vienna on Thursday, and then you don't want to do the Jubilee? Throw that into the mix as well.
That's coming up at a meeting this afternoon as well, with the Jubilee
I look
starting
forward
tomorrow.
to the planning meeting a little
Me and
bit
Lisa
later.
will be in London because John will be on an extended super bank holiday weekend.
I think Bramo's going to give that a miss too, Tom. Can I get to the commodity market just
Please, the
briefly?
commodity markets.
Thank you. WTI very close to 120 yesterday. I think 119.98 at the highest. Then a Wall Street Journal report came out and suggested that OPEC Plus could drop the plus, be negative Russia, and ultimately have some kind of production deal. That's the speculation now. The speculation fueled by that journal report. Right now, crude off the highs of yesterday, but positive on the day by 0.9%. WTI 115.69. And for many of you, you don't see that price. The price you see is the price of gas, Tom, and that's pushing 470.
Yeah. Well, you know, that's
the problem.
That's where we are. I mean, we're elevated, to say the least, and many people say higher through June.
Is that your version of the Fed minutes?
Yeah, several.
A couple, many, perhaps. That's the cross-asset price action. We've got a treat for you. If this wasn't enough.
This is a treat.
We've got some single names with Bramo. Good morning, Lisa.
Good morning. I just got to say, I love standing over here and listening to you guys try to figure out our road trip schedule. I will go where I am told. I'm happy to remain silent. What I'm looking at today is the partition between services in the tech world versus hardware. What we are seeing is services continue to be robust. Demand is there, despite some of the concerns about about supply chain disruption. Salesforce earnings came out yesterday after the bell. They actually increased their projected earnings, their shares popping more than 9%. Amazon and Alphabet, the reason why I looked at those is because these also are big web services, cloud service providers. Those shares also gaining ahead of the market. Amazon up about 1%, and Alphabet, Google, we should call it, up about 0.4%. Tom, you were talking earlier about Tesla. I was also looking at Tesla shares after Elon Musk came out and basically said, if you don't come to the office 40 hours a week, and I mean the main office, find another job. Those shares down 0.6%. How much of an aberration is it for one of the representatives, of the younger crowd, of the more modern, more millennial crowd coming out and saying this? To me, that was my takeaway from this, because that's unusual. Typically, it is the younger set that are more amenable to staying and working from home and being more flexible. How much does this go against that image right now that Elon Musk has been trying to go out there?
It's going to be an HR football for the next 12 months, no question about it. I should note the death rate from COVID today tipping again constructively in one survey under 300 deaths. That's a positive sign, Lisa.
Honestly, what does Elon Musk do that's not an HR football? That is one question. HP reporting, am I wrong?
No.
Well,
Can I just clear
John.
one thing up about the millennials? I think the millennials get too much flack. It's the Gen Z. Gen Z doesn't not only want to come into the office, they don't want to work, Lisa. So I'm not sure there's a problem for Elon Musk over at Tesla, because they're probably not working over at Tesla.
You're worried about the cat mafia, worried about the Gen Z millennial.
They do not want to work.
Honestly, you can make whatever argument you want. What it really represents to me is it cannot be bifurcated between young and old in terms of whether to come back to the office or not. It is idiosyncratic and it is specific to different cultures. And I think that seems to be one takeaway. HP reported earnings and they came out better than expected. Those shares are popping. Those are more of the hardware. Basically, demand there is robust, which is interesting, but the supply chain disruptions have been an issue. And Hewlett-Packard Enterprises, HPE, that is the service side, reporting after the bell. Those shares gaining with the anticipation that perhaps they'll provide something of a sales force.
Lisa, thanks so much. This is not a small matter. Lean forward and listen, Global Wall Street. There's a guy up in Connecticut, runs a small shop, who says cash is trash. Deborah Cunningham joined Federated when she was 12 years old. She's been doing this forever. She is the absolute dean of global liquidity markets and CIO at Federated, Hermes, CFA, Pittsburgh, and the rest of it as well. And Deborah, you go after Mr. Dalio and you say cash is an asset. Discuss why cash is not trash.
Well, first of all, I want to know how I can get in on the trip to Vienna.
Very
Please
good.
include me in those emails.
We will.
As far as the cash markets at this point, as you mentioned earlier, we have been in a zero yield environment for the better part of 14 years now at this point in time. It's not a healthy market. 17% isn't healthy, but 17 basis points isn't healthy. We are now getting back to a point from an economic standpoint where we have an inflationary environment that is above the bare minimums, 1.5% to 2.25%. In that environment, we need short-term yields that are above that, and we are getting to that end result. As such, your cash is now a valuable investment that no longer is just there earning your earning safety and a minimal return. It is now not only earning safety, but also earning a viable return above where the inflationary rate is. We're getting there. We're not there yet. But certainly above, sort of the zero bound where we have been locked for a very long period of time.
And the heritage of this, folks, with the federated funds basically is a generalization. They invented the money market fund. There's some that would quibble with that, but they've been doing this and owning the high ground on short-term paper for years. Deborah Cunningham, talk to Lagarde and the ECB, as John and I were talking about. Should we fear these initial rate rises from any major central bank?
Well, I do think the ECB, as was mentioned before, has some unique issues going on with it. Certainly Brexit, complicated, and was a factor that led into some of the shortcomings of both the UK economy as well as the European economy in broad terms. So I think that's a factor that still has to be dealt with in a way that we are not subjected to here in the United States. Having said that, when you look at those economies, yes, they're not as vibrant, they're not as fulsome, and certainly from a labor market perspective, they don't have the same, numbers that we have along those lines, the same strengths that we have. And as such, there are more challenges. And yet, they should not be in a negative interest rate environment. They should be at a point where there is cash, there are cash earnings there as well. The economies, for the most part, are not in any kind of danger of going into a recession. Not a large growth environment, but when you're looking at sort of steady and sure, you may see some setbacks as you go from -5 to 0 to +5 to 1, but that's part of what needs to happen in order to get out of I think part of the malaise that they have been in addition to Brexit, has been the negative rate environment, where there has not been healthy fixed income alternatives.
Deborah, just real quick here, I'm wondering whether you're actually seeing investors respond to this idea that cash is not trash, that it's a viable asset class in its own right with real yield. Is that something that you're seeing create a shift away from riskier assets back into cash for the asset value?
Yes, it's out of riskier assets, absolutely. It's also out of bank deposit assets, because those don't follow the natural market rates. They're an administered rate, and so they remain in that zero bound for the most part, for most banks who don't want deposits. And it's certainly something that I think is a welcome alternative for investors that don't want to take on a lot of risk, want to maintain a lot of liquidity, keep their powder dry, yet still earn a return in the process of keeping their cash invested.
Deborah, looking forward to your appearance in Vienna. Thanks for being with us. Deborah Cunningham there at Federated Hermes. Lisa, yields up on the front end by 3 basis points this morning. Let's call it close to 260.
Well, but this really presents a conundrum, right? Because if investors start to put their money into cash, does that indicate that they're basically betting that inflation is going to come down? Because on a real basis, they're still not getting yield. So is cash really preferable to bonds that are yielding more? Is it preferable to riskier assets that are a better inflation hedge? It's a very tricky moment, which is the reason why cash itself is polarizing for the likes of Ray Dalio, as well as Deborah Cunningham.
Where else do you put it? Right now, you're going to face the relative loss versus inflation, or the absolute loss in capital depreciation, because markets get absolutely hammered, and they have been over the last few months. That's the problem.
And this is one reason why people keep going into commodities, and again, why a lot of people are saying it's surprising that commodity prices aren't even higher, given that that has been the main inflation hedge for so many investors.
Well, they're pushing hard this morning, Tom. 115.80 on WTI.
Yeah, I'm going to watch it. 117 on Brent crude is maybe what I'm watching more, the global price of oil. And John, you look at the peripheral distillates as well. I'll get it out. The distillates as well, like diesel. And the answer is we begin June with a serious hydrocarbon angst.
And looking potentially maybe at some downside surprises in the data. That's what we've started to see recently. Lisa talked about that yesterday. It's such a good point. It's starting to build, which is why for some people who believe this Fed takes a pause, they take every single downside surprise and say, you know what, that validates my position. That's what the Fed's going to do. If the Fed keeps pushing forward, that's where the pain's going to be. That's where the pain's going to be later this year. From New York City this morning, good morning. Bill Dudley, the former New York Fed president, coming up on this program very shortly.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the US. President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 15 miles away. The US says Ukraine has promised not to attack targets inside Russia. In the UK, consumers are being urged to brace for inflation getting worse before it gets better. The British Retail Consortium says that fresh food prices are now rising at their fastest pace in a decade. It says fresh food rose 4.5% in the year that ended in May. China is planning for years of COVID zero, with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. Shares of Salesforce are rising today. The company raised its annual profit forecast, a signal that demand for business software is holding up despite a broader downturn for major tech firms. Salesforce co-CEO Mark Benioff says that so far the demand environment remains strong. And the richest person in the world doesn't appear to think much of working from home. Elon Musk apparently sent an email to the executive staff at Tesla with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
The economy is already slowing. 50 basis points may not be doable as we move into the fourth quarter, or even later in the third quarter. They can resort to balance sheet reduction at a faster pace, which will provide nice upward pressure to the longer end, or at the very least, provide a floor to longer rates.
That was Lindsay Piegza, the Stifel chief economist from New York City. This is Bloomberg Surveillance with Tom Keene, Lisa Bramwitz and Jonathan Ferro. Futures positive 0.2 on the S&P, on the Nasdaq up about 0.1%. Yields higher by 3 basis points, pushing 290, 287, 85. Bill Dudley, the former New York Fed president, out with this morning. Tom, here's the headline of his new column. The Fed's mild inflation forecasts need explaining.
They do. They need explaining. It is a brilliant note. I'll have it out on Twitter. I'm sure John and Lisa will as well. William Dudley is the former president of the New York Fed and, of course, writing for Bloomberg. We're thrilled that Bill Dudley could join us this morning. Bill, buried in your essay on inflation is a single sentence on what it means for the labor market. April of 2020, a 14.7% unemployment rate. We're at 4% at the beginning of this year. We're now down to 3.6%. I need you to explain to our listeners and viewers why it's the Fed's job to move the unemployment rate, as you state, up above 4%.
Well, the labor market is the tightest basically it's ever been, and you can see that by the ratio of unfilled jobs relative to the number of people that are unemployed. That ratio is 1.9 to 1. In February 2020, it was 1.2 to 1. So we have a labor market that's unprecedentedly tight. The Fed needs to loosen that up, or wage pressures will accumulate, and that will keep inflation above the Fed's 2% inflation objective. The problem the Fed has is that in the past, it's been very, very difficult to push the unemployment rate up meaningfully without precipitating a hard landing. That's what the Fed's going to try to do this time, but it's extremely difficult to do. And they haven't really been as forthcoming, I think, in their forecasts as they need to be, because if you look at their last summary of economic projections, for example, the disinflation occurred almost immaculately. The Fed didn't really tighten very much. The unemployment rate didn't rise, yet inflation came back to the Fed's 2% target. And it really begged the question of what caused inflation to come down. I think the way you get inflation down is you need more slack in the U.S. labor market. That's not a friendly message from the Fed, but that's what's necessary at this point.
And Bill, just to put some numbers on that, as you say, core PCE year end for the Fed 22, 4.1%, 23, 2.6, and unemployment 3.5, and then 3.5 again. And many people have been asking the same question. Bill, you know the chatter right now is this conversation about a pause in September. How are you interpreting some of that conversation?
I wouldn't put too much stock on it. I think what's happening is the Fed's pretty convinced that they need to go to something close to neutral, and expeditiously is the way that they put it. And so that's what they're doing. The notion that at some point they're going to take a pause and look around, of course that's going to happen at some point, but it's going to be driven by the economic data. I think that the economy is going to have enough momentum to keep the Fed so the Fed will keep going into the fall. The market's priced to a peak in the federal funds rate of 3%. I think we're going to get to there pretty easily, and the Fed will probably actually have to push beyond that ultimately.
Bill, what kind of unemployment rate are you looking for to indicate perhaps a tightening, a loosening in the very, very tight labor market?
Well, the Fed's own forecast is that a neutral unemployment rate consistent with 2% inflation is 4%. So I think you need to get the unemployment rate up to at least 4%. The fact that we have so many unfilled jobs suggests that maybe the unemployment rate consistent with 2% inflation is even higher than 4%. So I think we need to at least get to 4%. And that's the problem. It's difficult to do that without precipitating a full-blown recession.
Bill, did you take any message from the fact that President Biden met with Fed Chair Jay Powell yesterday, that there was this focus on the Fed being the main driver for what happens with inflation going forward and the politicization of the Federal Reserve?
Well, I think Biden was actually not politicizing the Fed. He was basically saying the Fed's job is to control inflation, and I'm not going to challenge the independence of the Fed to do that. In some ways, though, he's putting the burden now on the Federal Reserve rather than on the administration. I viewed it as a political event, not an economic event. I don't think it changes what the Federal Reserve is going to do or what the Biden administration is going to do.
Bill, we had a one-off medical event, a pandemic of our lifetime that got us out to 14.7% unemployment. Can we cut any central bank slack and have them extend out the x-axis and just take longer to get this done, to repair off of this medical event?
Well, if they take longer, the risk will be that inflation will stay higher, and then that will start to get embedded in higher inflation expectations, which will make their job more difficult. The good news for the Fed right now is they're highly credible. Market participants expect the Fed will do the job and get inflation back down. Inflation expectations at the longer-term horizons are still very well anchored. If the Fed dawdles, then the risk is that inflation expectations become less well anchored, which will make it harder for the Fed to get inflation back down.
Bill, is your view hardening, not softening, based on incoming data that this Fed funds might end up with a 4 handle and maybe not a 3?
I don't think it's changed too much. I mean, the good news is that the Fed has things in hand today in terms of market confidence, in terms of inflation expectations being well anchored. That's the good news. The bad news is I think people are understating how difficult this job is.
What do you make of this idea that they can target job openings, Bill? JOLTS data, which is a little bit dated. What do you make of that?
Well, I think their story is a quite an optimistic one, that they can tighten monetary policy sufficiently to reduce the demand for labor without actually pushing up the unemployment rate meaningfully. This is the tightest labor market I think we've ever had, frankly. And it seems to me if the labor market is tighter than it's ever been before, that makes the job more difficult, not easier.
Super hard. Bill, wonderful to catch up. Bill Dudley there, the former New York Fed president, on the path forward, and a really interesting piece on the Fed's inflation forecast available on Bloomberg.com and on the Bloomberg terminal on the Bloomberg opinion column. Lisa, to bring job openings down, to take out some demand from a hot labor market, to rebalance supply and demand, and ultimately not see unemployment go higher, that's the dream? Is it going to be real?
Right now, here are some of the issues right now, and I'm stuttering over my words because the uncertainties are just so monumental, not only with the economic trajectory, but the data itself, right? I mean, we saw last year the revisions to the labor market data came in much hotter than we had previously expected by the end of the year, so that all of a sudden the summer months did not look like a softening, did not look like we were seeing some sort of deceleration in how hot that labor market was. How much can we really look at these job openings as concrete? Some people say perhaps people are just listing 15 job openings because they're not getting enough applicants. I mean, honestly, there's so many people having their own interpretations of this, which is the reason why you get 5 economists in a room and you get 6 different opinions on the trajectory of where things are going.
Isn't that always the way? On the one hand this, on the other hand that, and on 5 different hands this, that, and this. This is from Delta. Just came moments ago, Tom. They see their second quarter revenue fully restored to 2019 levels. And this is what they said on the second quarter capacity. And I think it's the capacity numbers that keeps getting my attention from the airlines. 82 to 83% versus the second quarter of 2019. They had seen those capacity levels up to about 84%. We are all living that. If you're traveling at the moment, Tom, we are all living that.
I look at 2 prices. I look at the trip to Paris just as a gauge, and I also look, John, at New York to LAX. Delta Airlines, $800 to $8 economy. I can honestly say I've never seen that number.
Unreal. So expensive at the moment. The stock is up 2%.
$800 economy.
Delta Airlines. The airlines are doing well, aren't they? For many reasons.
We're taking the
living
trip.
it.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Biden administration has a very real problem here. They've got to get inflation down to a more comfortable 3%.
This inflation's really coming from everywhere.
We're going to be in that 3 to 4% consistent inflation level. And I think it's going to be for 3 to 5 years.
I think if inflation peaks, it will provide some relief.
I think the Fed is very optimistic that they're going to see lower levels of inflation, but they're not forecasting 2% inflation anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Bloomberg Surveillance greets June. John, 1 year ago, Brent crude up 66% in 12 months.
What a turnaround, Tom. And look at the equities on the S&P 500. They're up about 60% as well. A massive move. And that's the place where the likes of Bank of America is still pretty comfortable, Tom, taking that exposure in the equity market in that industry specifically.
Everything we do, John, we talk about the Fed, the president, everything, ECB, all of it is backed by a commodity foundation, which is a commodity boom.
And that's why a lot of people, Tom, think this Fed has got a job to do, and that's to take out demand from this economy. As Bill Dudley, the New York Fed, the former New York Fed president, said just moments ago on this program, the challenge for this Fed is so difficult. How do you take out that demand from a hot labor market, rebalance the labor market, supply demand, and Tom, do that without unemployment climbing? That's in their forecast, 3.5% on unemployment this year, again next year. In reality, that is so difficult.
Jobs from 14% unemployment down to 3% unemployment. We're back, maybe Bill wants to model out to 4% unemployment. What's the risk, John, that all of a sudden 4.1% becomes 5.1%? That's unacceptable to Americans.
And then what does the Fed do, Tom? Are they still hiking? I doubt it. I doubt it, because CPI is going to be going in a very, very different direction, or maybe it won't. And that's the fear. You end up in this situation where inflation persists and growth starts heading lower. What does the Fed do in that world, Tom?
On June and on a June reset out front of a mid-year reset, Lisa Abramowitz, it's real simple. Bonds say all. What do bonds say on June 1st, 2022?
That maybe it's time to shift back after a shift in the narrative. Basically, we saw people saying that the Fed was going to go really quickly and actually get out ahead of expectations. It was who could out-hawk each other in terms of how much they could up their projections for Fed rate hikes. Then you had the Fed pause, right? Raphael Bostic sort of took the mantle on that. And now it's shifting back again that the Fed will have to be more aggressive, with Andrew Hollenhorst of Citigroup coming out this morning and saying basically all indications show that inflation is not slowing. And without inflation slowing, you're not going to get that pause.
We pause for the surveillance sports report right now. John, Rafa Nadal, this Friday, 2 days from now, 36 years old. I'm sorry, it's a huge deal, underreported in America.
Seeing him smile yesterday, Tom, at the end of that game after beating Novak across 4 sets. I think it was John McEnroe, that said years ago that beating Rafa in Paris at the French Open is one of the hardest things to do in sport across 5 sets. Tremendously difficult. And Tom, he's only lost in that event, I think, 3 times. 3 times across his career. Just unreal.
Across the span of June, we'll have to watch that. And of course, the Red Sox are going to drag themselves back to 500 baseball.
I thought we didn't talk about the Red Sox, Tom. I thought that was done.
It's too painful. We'll move on from there. Futures up 15, Dow futures up 170. John, June, in honor of the Queen, we quote the Dow often.
Do we? Does the Queen like the Dow? Is there a price target at Buckingham Palace we need to talk about?
She follows it every day.
Okay. Yields high by 3 basis points on a 10-year, 287.49. It's a quiet morning, Tom. Crude advancing 115, let's call it 60, up 0.8%.
I mentioned coal in Australia. I'm sorry, I'm watching some of these small items to see if copper turns around on the China opening. Brent Schutte joins us now, Chief Investment Officer, Northwestern Mutual Wealth. Brent, what are people actually doing with their money? You observe this across all of the conservative Northwestern Mutual platform. What are they actually doing?
Well, I think the good news over the past few years, people have actually saved money. And so one of the conversations that I think gets avoided quite a bit is that the consumer is in pretty good shape right now. So yes, gas prices are eating away at that, but overall the consumer remains in good shape. And I think that's going to help them get through this time period where inflation is high. But importantly, I disagree with the Citigroup message that you had earlier. I do think inflation has peaked. I think it's rolling over. I think that's already begun. And I think that's going to give the Fed the ability to not tighten the U.S. economy into a recession, which I think is the market narrative that kind of came out last week, but I think you'll continue to see in the future.
So, Brent, based on the rally of last week, can we learn anything about where the leadership comes from in this equity market that you're a little bit more constructive on?
Yeah, I mean, we've been pounding the table for value and things that are cheaper for the past year, and that's played out well. So you've seen a market dislocation because you've had an economy that is moving back towards what it was pre-COVID. You have monetary and liquidity issues that are moving back to pre-COVID. And the most expensive names have been repriced because you've repriced the bond market, and many of those names actually were stay-at-home stocks. And so if you've been in value stocks, you have not experienced near the downturn that you have in the more expensive stocks. And that's where we continue to focus, because it's not going to get that much easier. It's still going to get tougher. But those cheap names give you a margin of safety that we would still want to own.
How big is the range of outcomes, Brent, if you're wrong, if the Fed doesn't pause, if frankly, yes, inflation has had a mechanical peak, but it doesn't come down all that much? Is your thesis completely wrong, or do you just have to tweak it around the edges?
I think more so tweak around the edges. And the good news is that we build a diversified portfolio. And so we've owned things like commodities for much of the past year and a half, 2 years, when it's been very unpopular to own. We've continued to own those because we did believe you would actually see what you're seeing today, which is an inflationary environment that is much different than the past. I have not believed that inflation was dead. I just thought it took longer to get there. And I did believe all the things that happened during COVID would lead to where we are today. We also own TIPS. We've actually moved out of that position right now because we do believe inflation's coming down. I guess the good news is that I think it'd be tweaks around the edges, but there certainly is a wide range of outcomes. And the most complicating issue is the Ukraine-Russia war, which quite frankly wasn't on the radar much before the past 2 or 3 months.
So it's interesting that you say that. I want to go back to what S&P Global came out with earlier this morning, where they basically withdrew projections for 2022 forecasts, even though this is a company that tracks other corporate balance sheets to get a sense of where things are going. What are you tracking, Brent, for some sort of compass at a time of such uncertainty?
Yeah, I mean, I think the big news is what happens with inflation. And certainly if you take a look at inflation and where it's been on the good side. That good side of the economy had pulled forward demand. Think about those earnings that we all worried about last week with, I think it was last week, Target, Walmart, Amazon, things of that nature where they rebuilt their inventories because they thought demand was here to stay, and that actually is now shifting. And so they're caught with heightened inventories. They're having to lower prices. And so if you kind of put all those together in a nice mosaic, I do think you will see inflation fall, which is the biggest question that's out there that people have is what will happen with inflation? And then secondarily, what will the Fed do about it? And you mentioned in your opening that the Fed talked tough. So people are worried about these rate hikes, but they're already priced into the market. It's what happens from here. And that's where I think there's some room for the Fed to go shallower and just a bit slower than what's imagined.
Brent, in the great moderation, we've had pension funds with a true actuarial assumption come down. They've brought that bogey down. And we've also had it in our heads. What are we going to take out of retirement plans per year? Are we at a point where you now need to increase your actuarial assumption or be able to increase what you take out of a portfolio?
Well, I mean, I think that I understand the question. I think if you're looking forward, I do think returns will be less than they have in the past. I mean, we've had a pretty good decade, even on the back of bad economic growth. I think in the future, you're going to actually have lower returns because the market, at least the majority of the bigger part of the market, is more expensive. I just think that people need to look overseas and in other places that haven't worked quite so well over the past few years. I think there's actually a positive story building where those equities are much, much cheaper. I know that people get tired of waiting for valuation to work, but I think there's probably a bit of a catalyst coming that will actually propel those areas of the market higher.
Brent, that screams China, doesn't it?
Yeah, I mean, that's an interesting commentary because you have to add geopolitical risk on top of that. But certainly places like international stocks trade at 12 times earnings, and those earnings are near levels they were 10 years ago. Contrast that with the U.S., where we're still, at 16.6 times forward earnings, which is not cheap, at least in the larger parts of the market. I think you're looking at something more like post 1999, 2000, where other parts of the market do better than the part of the market that did well during that time period and was quite frankly overvalued. I think you need to look elsewhere right now.
So, Brent, are you saying that maybe the S&P might be mechanically challenged at the index level for quite a while, given its weight into big tech?
I think so. And I think that was the message post 1999, where you had parts of the market that were overinflated. They had been brought forward by demand. They had done well. Investors had bid them up to levels that were probably a bit excessive. And then you had other parts of the market do quite well, and it wasn't a lost decade for those parts of the market. I think expectations are still so low outside of those parts of the market that everybody wants to talk about that you have the impetus for a push higher in the coming years.
Fascinating, Brent. Trudy, thank you, buddy. As always, good to catch up. Brent Shitty there of Northwestern Mutual. Tom, a more constructive view in some places, but that last point, just on how challenged the index level might be because of the weighting to big tech, that's where the advantage has been for American equities at the index level to allocate to that passively, and some people suggesting that may be where the disadvantage is for years to come.
Well, I agree with the passive weighting debate there. We've seen that before, and of course, years and years ago with the huge energy overweight, I'm going to say 30 years ago off the top of my head. What I found really interesting there, John, is once again, major shops saying we've got to at least study, if not act on international investment. And I'm so old-fashioned here, John. To me, the overwhelming factor there is you need a weak dollar to make it happen, and we just flat out through the month of May didn't see that.
Are you saying that's a symptom, Tom, or a driver of?
Driver
you get the
of.
weak dollar because it's a symptom, you think it's a driver of.
Driver of. And, I defer to Ibrahim Mabari or George Cervellis to tell me I'm wrong on that, but I'm looking at 102 DXY. Maybe the yen's giving me some love here out past 130 would be interesting, but euro? I mean, come on, if they pop 50 beeps like Deutsche Bank says, you're going to get a weaker euro? I don't think so.
Hey, TK, that's the problem, though. Lisa's mentioned it many times. I have too. Can you say with conviction that higher rates of the ECB means a positive euro story or a negative one?
That's the drama that keeps us employed.
That's going to keep things really entertaining at the ECB next week. That's why you should stay tuned to full coverage of a non-snoozer presser with President Lagarde. I can't even promo it, seriously. Yields up 3 basis points, 287.31. Equities positive, 1/3% from New York, heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Treasury Secretary Janet Yellen says she got it wrong last year on inflation. Yellen made the admission in an interview with CNN. Last year, Yellen predicted that elevated inflation wouldn't pose a continuing problem. Now she says she didn't fully understand the circumstances. Meanwhile, the Federal Reserve is about to deploy a second tool to curb inflation alongside higher interest rates. It will begin shrinking its $8.9 trillion balance sheet. Officials don't know how effective it will be. They say it should cool price pressures by tightening financial conditions. The U.S. is ramping up military support to Ukraine. President Biden says he'll give the Ukrainians advanced rocket systems and other weapons that will allow them more precision in attacking Russian targets. The weapons will let Ukraine hit targets as far as 50 miles away. The U.S. says Ukraine has agreed to not use the weapons to attack targets inside Russia. And the city of Shanghai reported its fewest coronavirus cases in 3 months. That came on a day when residents celebrated an end to mandatory home isolation for most of the city. Shanghai saw just 15 new infections Tuesday. That is a dramatic drop from the peak of more than 27,000 a day back in April. And Delta Airlines is back to where it used to be. The carrier estimates that second quarter revenue will be, quote, fully restored to 2019. Capacity is expected to be about 83%, just 1 percentage point off the 2019 figures. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
You have to just look at the cost structure of the industry. You have to look at where new production is coming and where it would be coming even if we didn't have $123 Brent. And I'd say it's more in the $70 range than it is in the $120 range.
Ed Morse taking the other side of the trade, the Citigroup Global Head of Commodity Research from New York City this morning. Good morning. Equity futures look like this on the S&P. Positive 1/3% on the NASDAQ. A similar amount, up by 0.32%. Yields higher by 3 basis points, 287.31 the 10-year. And crude higher by 8 or 9/10%, 115.66. Here's a note from our next guest, Tom. Back in April, we lampooned a Washington Post opinion writer for their obtuse observation that if it were not for that darn inflation, Biden's economy would be extraordinary. The writer went on to say that Rubin's logic was as intellectually robust as us saying that if our grandmother had wheels, she would be a bus.
That can only be the wonderful Stephen Schork, founder and president of the Schork Group, John. His note, folks, is just the breath of fresh air within the petroleum business. Is Ed Morse of Citigroup, who we just listened to, talks about the macroeconomics of the moment. Stephen Schork is hyper-defined. Steve, let me go to the single sentence of your note. 99% of us are simply getting poorer in this commodity surge. Will that trend continue?
Absolutely, Tom. So real disposable income, what we have to spend, has fallen in 10 of the past 13 months because of runaway inflation. Inflation, by the way, that all the smartest people in the world spent the better part of last year doing yeoman's work, making fools of themselves every single week, saying that, oh, inflation is transitory. Yes, if I don't have to eat, if I don't have to put the lights on, if I don't want it to stay cool this summer, yes, right. Inflation is not a problem. But what we're seeing now, Tom, it always comes down to commodities. And what we're looking at in the energy industry, well, we know that story. But what most people, especially the ESG crowd, or the people that are taking the war against natural gas, is the war on natural gas is a war on the American consumer. So what it has done to fertilizer prices, of course, natural gas is a key feedstock into synthetic ammonia fertilizer. So we're putting fewer seeds into the ground this spring, which means we're going to take fewer crops out of the ground in the fall. So the inflation has not peaked. Right. I mean, it's peaked on the core level, but as far as energy and food, which is all dear to us all, inflation has not peaked. And Tom, this is the problem. Runaway inflation at the gas pump and at the grocery counter has been the lead indicator for recession of the last 6 recessions in the United States, beginning with the
Steve, I want to go to the hyper detail of your note and your true expertise on distillates. Do you have any optimism we're going to invest given these higher prices?
Well, as Winston Churchill once said about America, we always make the right decision after we've tried every other decision. So I'm not quite sure we're there yet. Here on the East Coast, of course, what has happened? Well, over the past 3 years, we've cut our refinery capacity by 40%. So now gasoline production on the East Coast has held steady. But when you cut your capacity to make things out of crude oil, something has to give. So while we've maintained the status quo on gasoline production, diesel production has fallen 40%. So right now, diesel stocks for the first time ever in the East Coast are below 9 million barrels. So we are looking at a dire situation in the diesel market, but we're not quite there. The smartest thing the Biden administration could do with regard to the energy crisis here in the United States is rescind the Jones Act. The Jones Act requires all interstate commerce, waterborne, be tagged on American flagged vessels. Well, guess what? We don't have enough American flagged vessels. You need to rescind the Jones Act, allow diesel, gasoline being manufactured in Houston, to put that on foreign flagged vessels, to bring it around the tip of Florida and get it into the East Coast. That is the smartest thing to invest in a short-term fix.
Yeah.
Regard to the longer-term fix, no, there is not a political will at this point to invest in fossil fuels. Thereby, the long-term structural imbalance between supply and demand will remain. High prices, therefore, have to remain, Tom.
Stephen, have you been surprised by how little pushback there has been on consumers with respect to reducing spending? There has been a reduction in real spending if you look generally at the trend. However, overall, they continue to spend more, even as you see new records every day of gas prices.
Yeah, absolutely, Lisa. Now, the calculus there has changed because we have substitutes in the market, i.e. EVs. So it used to be consumer spending would drop off and gasoline prices, national average, hit about $3.60, $3.80. Natural gasoline, gasoline on the NYMEX now is trading over $4 a gallon. So the AAA average right now is about $4.60 national average. Given where futures are trading now, by the 4th of July, gasoline prices will be another 20 cents higher, $4.80. I do have to believe, even though we've never had anything to mark this against, we will start to see that. But to your point, yes, that it has been one of the positives. Consumer spending, the last read came out last week, stronger than expected. But the problem there is that we're waiting for the other shoe to drop because the personal savings rate plunged to 4.4%. We are well below the 30-year non-recession mean on savings and the 60-year non-recession mean on savings. In fact, savings rate is at the lowest point since 2013. So the bottom line, Lisa, is we've run out of all the stimulus money. Americans are dipping into their piggy banks. It costs more to drive to your picnics, to go to the beach, so forth. So in the next quarter, yes, I do expect to see consumer spending to tail off, which of course is a problem, given that consumer spending is 2/3 of the U.S. economy. And therefore, this is why I'm still comfortable in saying, if the United States is not currently in recession, given these food costs, these energy costs, our falling income, we will be in a recession within the next 6 months.
Stephen, usually I say thank you, but that one was a little bit depressing. Stephen, thank you, though. Anyway, Stephen Schork there of the Schork Group. Thank you, buddy. Good to catch up. And right on cue, Goldman at the gate, cutting price targets on Ford, GM, Tesla.
Wow.
They say this, Tom, supply chain troubles in the near term, weaker demand in the immediate term. They go on to say key metrics that correlate with auto demand, housing data, consumer sentiment, throw in PMI metrics, the ISM, consumer demand data points, they've weakened, and they're removing those price targets and cutting them to 14 from 18 on Ford, Tom, GM 46 from 59. Still punchy price targets on the likes of Tesla, 1,000 from 1,200. But the direction of travel of the story there, Tom.
Exactly. The direction of travel resounded by Itay, my colleague today over at Citigroup, John. He was a little more optimistic than that, but he made it real clear there's some intermediate trends in autos which are challenging.
And those challenges look to come through the auto market. Lisa, if the Goldman team are leading us towards the truth right now, and that seems to be where things are heading.
I do wonder whether the macroeconomic headwinds that are suddenly so surprising to executives come from China, and frankly, that the extent of the lockdowns perhaps weren't known to such a degree.
Are you questioning the surprise in the surprise? How surprised we should be about the surprise?
It's a toxic
derivative surprise.
It's a what, Tom?
A mushy surprise.
A mushy toxic.
A sea of mush, as you called the English breakfast a little bit earlier this morning. I've not forgotten.
I actually really enjoyed it. It was great.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
From New York City this morning, good morning and hello to the month of June, goodbye May. Futures positive about 0.5% on the S&P, and the Nasdaq 100 up by 0.47%. Yields just a little bit higher. They bleed higher 3 basis points, 287.31 on a 10-year, and crude all over the place yesterday. Nicely positive, then whipsawed by a Wall Street Journal report, which led some people to believe maybe we can get some kind of output deal without Russia involved. Crude lower, then ultimately positive again, up by 1.4%. TK 116.28.
There it is right now. John, we got to note the market's turned around. I mean, we got a lift to the market.
It's nice. 0.5%.
VIX under 26 still gets me going from 31 here.
Should we call it a quiet move, Tom?
Yeah, it's quiet.
Nothing overly dramatic.
It's nice. Anytime a move in the equity market is called nice.
It's a nice move.
It just shows how long it's going to last.
Give the bulls something. It's a nice move. Just give them something. You know, give them some crumbs, all right? It's been a tough year.
This is a joy.
Is it?
Can we move on?
This is a joy.
This is a joy.
This is a joy.
Mickey Levy's going to hang up. We're gonna move on here.
I think other people might too.
Long ago and far away, out of the crisis, there was analysis like Chair Yellen getting, inflation wrong in the last couple of days, where a group of people said, beware inflation. And the coined inflationistas maybe got it a little wrong 10 years ago. Mickey Levy was part of the Shadow Open Market Committee. Of course, his work with Bank of America and now Definitive at Berenberg Capital Markets. And right now, Dr. Levy, things have changed. It is people who worry about inflation with all the heritage of Alan Meltzer, Marvin Goodfriend, and others of the Shadow Open Market Committee. And now you are amid high inflation. How do you interpret the ancient worry of inflation now that we're amid real, tangible inflation?
Well, Tom, I mean, you just feel it everywhere. The inflation was generated in a classical manner, just excessive monetary and fiscal stimulus, generating too much demand. At the same time, you had supply constraints. And now you just feel it. It's an inflation tax, and you feel it imposing itself on real purchasing power. And so the question is, how embedded has the inflation become in wage and price setting behavior? Once again, and the Fed has a long history of this, the Fed has waited too long to exit from its easy policies, right, and inflation's come back. And now the question is, will the Fed be able to weave this fine needle of raising rates just enough to slow the economy to take the edge off inflation without tightening too much? And it's going to be a challenge.
Are you using here conventional economics, including targeting a la Taylor rule and other fancy mumbo jumbo? Or Mickey Levy, is this so original how we got here and where we are now that you've got to be as data dependent as Jerome Powell?
Well, yes, you have to be data dependent. I mean, it was almost as if last year the Fed was deaf to the data. But now the difficulty is monetary policy, works with a lag. So, and the problem is you have this deeply negative real funds rate, and the Fed doesn't know how much it needs to raise rates to dampen things because, some of the higher inflation is due to supply constraints. And it's a guessing game for the Fed as to how much they need to raise rates to dampen demand. Now, it definitely has to raise rates probably more than the Fed funds futures is suggesting. But we're in this very difficult situation. Tom, the other thing I would add, I hear so many people talking about, recession now. And if in fact we're on the verge of going into recession, then this expansion peak is very, very different than all other expansion peaks in its economic and financial characteristics. So we could be entering a gray area, and I caution people about thinking in binary terms, either recession with a capital R or continued economic expansion. It could be a very difficult to define gray area that we're entering.
Who's further behind right now, Mickey, the ECB or the Federal Reserve?
Oh, the Federal Reserve is core inflation in Europe is well below that in the U.S. Europe faces a whole host of other issues, not just high inflation, but it's very low potential growth. But in the U.S., whatever measure of inflation used, core inflation is much higher. And if you look at different measures of inflationary expectations, the Fed has a difficult task ahead of it to raise rates, enough to interrupt that wage price feedback mechanism.
Do you buy the pause argument that a lot of people are eschewing, basically saying the Fed will take a break from raising rates 50 basis points, maybe perhaps come September, and sort of take a look at how the effect is really trickling out into the economy?
Lisa, that's a great question. Okay, so the Fed dithered through last year. And now it's all excited that it needs to hike rates aggressively. And the question is, not only will they raise rates enough, but will they have the resolve to really lower inflation? And there, it depends critically on the economy and particularly labor markets. If, as the Fed hikes rates, labor markets remain okay, the unemployment rate increases just a touch, but not that much, then the Fed will continue to hike. But I wouldn't be surprised if, not this September, but later in the year, early next year, when the unemployment rate starts moving up, the Fed, comes out with a statement saying, oh, we have to be balanced on our dual mandate, and it kind of backs off from things.
Right.
Mickey, we're in a difficult situation.
Mickey, Chair Yellen came out yesterday and said she was wrong on inflation. What did the people get right who pushed against transitory? Let them take a victory lap right now. What did they get right? Dudley, Alarian, Levy, Summers, the rest. What did they get right?
That All you needed to do, Tom, was look at broad measures of aggregate demand, like nominal final sales to domestic purchasers or nominal GDP. It was accelerating sharply last year, which was completely inconsistent with what the transitory camp said, that it was just supply constrained. And so basically the root of that was we had this unprecedented amount of deficit spending that was, and the bonds the Treasury issued were largely purchased by the Fed, purely classical. If you just put on simple standard fiscal policy multipliers on what the fiscal authorities did with deficit spending, you would have predicted a surge in aggregate demand. And when the data started showing that, it's really quite striking how the Fed and the Biden administration were in complete denial.
Mickey, groupthink. It's been a problem at the Fed for a long time. Mickey, have we fixed it?
This is truly a wake-up call. The Fed has just gone through so many unforced errors that it really needs this wake-up call. We hope it learns from the current situation, but I think there still is too much groupthink. The big Furbus macro model that the Fed uses has not been working, but the Fed still talks about it as if it's working. The Fed really needs to think more broadly. I think it learned something from this, but I still worry that it just relies so much on its own discretion and does not use a more rules-based approach to monetary policy.
Mickey, awesome to catch up. Mickey, leave you there.
There's a Mickey we know.
Berenberg. Mickey, fantastic. In fact, the Taylor rule was coming up there, Tom.
I think that's where he was heading.
Just a little bit.
A little bit. Folks, this is what we try to do. Different opinions all the time. John, a doozy from JP Morgan moments ago.
Give me the number, Tom. Give me the number.
Christian Malik, who joined us in London. And, of course, there's people that disagree with the JP Morgan view. See Ed Morris over at Citigroup. But they reaffirm on the dynamics between Russia and Saudi, and that Saudi, quote, will keep the powder dry, that you get a risk towards greater than $150 a barrel.
139 is the high of the year. That was the 7th of March. Tom, trying to convince people that we haven't seen the high of the year on crude.
Oh,
can you imagine?
There's nobody out there. Yeah.
150 plus.
Well, it's the way they walk through it. And, I want to make clear, this is not some throw a dart at the dartboard.
No, sure. There's a lot of work on capacity that's been done here by Malik and the team.
A lot of work on that, but it's about unforeseen events. And Christian walks through, if Russia blinks, what does Saudi Arabia do? The usual ballet of OPEC+. Plus, of course, if we went to Vienna, we would have a better knowledge of this, John.
Ramo would like to talk about this nice move in the market this morning. At least the future's up 0.5%.
It's so nice. It's so sweet.
A nice move, isn't it? The Nasdaq
honestly,
up 4/10.
Okay, look,
market,
the fact
Lisa.
that we're getting, thank you, I appreciate that. The fact that we're getting a lift, though, is notable, especially given the fact that people are still seeing interest rates go higher. I honestly can't make much of any of these moves because honestly, they'll be different in a half hour.
Of course they will.
I mean, it's like, it's
great.
Always
the way,
nice.
isn't it?
I know,
it's always
but
the way.
It's all over the place these days. So how much conviction can we really have?
We said it when we started the program earlier this morning. When we look back at May, did it feel like a month where we were flat on the S&P 500, up 0.01%? Anything but.
Honestly, uncertainty is deeply unpleasant. Everyone feels that. And that is what we have right now. And it's profound uncertainty. You see that in some of the fluctuations and, frankly, the single name moves in the wake of certain earnings reports. How do you parse that into an index level call is beyond me.
John, we're uncertain about our uncertainty.
We are. It's very philosophical.
It's the pendulum of fixed income only.
There is a conversation you do not want to miss. It takes place in a couple of minutes' time. It's Lisa Rabbit sitting down with Howard Marks of Oak Tree. Don't miss that. It's coming up very shortly on Bloomberg TV and on Bloomberg Radio. Futures up 0.4%. It's a nice move. Ramo said so. From New York.
No.
This is Bloomberg.
You can't put that on me.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine will get advanced rocket systems and other weapons from the U.S. President Biden made the announcement in an article published in the New York Times. The rockets will allow Ukraine to hit targets up to 50 miles away. The U.S. says Ukraine has promised not to attack targets inside Russia. European Union ambassadors are set to approve the bloc's sixth package of sanctions against Russia. The final compromise targets Russian oil transported by ship, but it spares crude delivered by pipeline to satisfy Hungary's demands. In the UK, consumers are being urged to brace for inflation getting worse before it gets better. The British Retail Consortium says that fresh food prices are now rising at their fastest pace in a decade. It says fresh food rose 4.5% in the year that ended in May. China is planning for years of COVID zero, with testing sites on almost every corner. Tens of thousands of lab testing booths are being set up across the country's largest and most economically vital cities. The goal is for residents to always be just a 15-minute walk away from a swabbing point. In New York State, Governor Kathy Hochul and legislative leaders pledged to raise the legal age to purchase an AR-15 assault rifle to 21 years old from 18. They'll also say they'll pass a package of measures to tighten gun laws this week. Officials cited the recent mass shootings in Uvalde, Texas, and Buffalo. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're in an environment now which is very different to the one we've seen in the last couple of decades, when both commodities and labour were easily available and relatively cheap. And now we're in an environment, probably structurally, where both commodities are becoming more scarce, more heavily contested and competed for, more expensive, and labour as well.
From London, Peter Oppenheimer. He is Chief Global Equity Strategist at Goldman Sachs. His views on an equity market and the hallmark here of a 1st June day is the uncertainty that is out there right now, which means everyone reading Howard Marks leans forward and reads a little more carefully. He is successful. He is a philanthropist. And Lisa Bramwitz, we know for certain, is a member of the Board of Trustees of the Metropolitan Museum of Art. The Met Gala is Howard Marks' fault.
Yes, well, we actually very much appreciate it for us who have spent many, many hours at the Metropolitan Museum of Art. There also is this question of investor psychology, and Howard Marks is co-chair and co-founder of Oaktree Capital. And frankly, one of the co-founders of the entire distressed debt market, really understands how psychology can drive what is perhaps the best philosophy going forward. And he writes these fabulous memos from time to time. His latest Bull Market Rhymes. Howard, thank you so much for being with us. I want to start with trying to understand investor psychology, and as a student of history, where are we right now in terms of bullish or bearish?
I think that attitudes were quite bullish prior to a few months ago, with the exception of a brief respite during the pandemic. We've been in a bullish climate since the end of the global financial crisis in 2009. Not wildly bullish, certainly not what I would call euphoria, but optimistic. And that has been crimped now. A lot of the big name stocks are off 50, 70, 80%. The whole market is off, I guess, probably 15% from the high. So I would say that attitudes are more balanced today. But when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. So we're happier today than we were 6 months ago. I don't know if we're going to be happier 6 months from now. That is to say that the bargains will be more pronounced. But at least, as they say, the bloom is off the rose.
At a time of such incredible uncertainty, how do you position seeing value now, but also preparing for seeing more value in 6 months?
One of the 6 tenets of Oaktree's investment philosophy, which we established when we started in April of '95, and have never changed a word, and I believe in thoroughly, is that we're not market timers. And that means mostly 2 things. We never sell to raise cash to prepare for a decline. And we never say it's cheap today, but it'll be cheaper in 6 months, so we'll wait. If it's cheap today, we buy it. If it's cheaper in 6 months more, we buy more. And I think that that works much better than an assertion that we know where the market will be in 6 months.
This is really important at a time when so many pensions and institutional investors have been shooting for that 7.5% to 8% bogey. We talked about that extensively in the past 5 to 6 years. This idea that that seemed completely unachievable in an era of quantitative easing. Suddenly, high-yield bonds have an average yield of more than 7%. Is this the best period that you have seen for pensions to actually hit their bogeys for more than a decade?
Well, I think that's right. Well, of course, many have hit their bogeys. It just didn't look in advance like they would, but the stock market and many other things have surprised on the upside for the last 10 years. But now, as you point out, one of our big activities is high-yield bonds. And a year ago, they were yielding in the 3%. One deal was even done in the 2s. That's not a very high yield for high yield. Today, as you say, they yield in the 7s. So a pension fund that needs 7 or 7.5 can make use of high-yield bonds. And everything, you know, see, when everybody gets concerned when prices decline. But if you flip that over, the flip side of price deterioration is increases in prospective returns. So now the prospective returns on many asset classes are higher than they were just a little while ago. And again, a much better climate for the bargain hunter.
Some people would counter this by saying inflation takes a lot of the value out of those returns, that basically on a real basis, you're still not getting very much. How do you counter that as a long-term investor by saying, you know what, at this point, it's worth it to get higher returns, even if on a real basis, it's not necessarily that much more?
Well, you're right in that we're not talking about an increase in real returns. We're talking about an increase in nominal returns. Most pension funds and other organizations reckon their need for return in nominal terms. You know, I mean, that is a challenge. Nobody knows what inflation is going to do. I think I heard out of one ear your previous guest say that, you know, some of the inflation factors will probably subside in the next few months, which means, all things being equal, an increase in real returns.
How much are you trying to game out where inflation is going to go over the next 6 to 12 months, considering the fact that I know that you do not time the market or look at a sort of day-to-day price swing kind of issue, but this really does determine how important some of these returns will be going forward?
Yes, it does, but I don't think there's anything to be known on that subject, and I'm sure we don't know it. You know, and another tenet of our investment philosophy, there are only 6, we're going to touch on 2 today, is that our investment decisions are not based on macro forecasts. Macro forecasts are very important. The only problem is they're rarely right. And more importantly, any one forecaster is rarely right more often than the others. So we don't make our decisions on that basis. We are what's called bottom-up investors. We invest on the basis of micro, not macro, companies, industries, securities, and we feel there, through hard work and skill, we can get an edge.
So where are some of the industries, some of the areas that you're actually seeing deep value?
You know, they are much more spread around than they were before. You know, some growth names are offering much better value than they did a year or 2 ago, down 70%. But, you know, we continue to find opportunities throughout the investment universe
picture. I know over the years, especially as the U.S. yielded less and less and yet less in real terms and in nominal terms, you looked overseas, in particular to China, as a potential area of prospective return. Has that changed as yields have gone up in the U.S. and frankly the economy has slowed so substantially in China?
Well, on the one hand, we have a preference for investing in the U.S. You know, the U.S. In most regards has the best economy in the world, and it has an excellent environment for rule of law, for being able to predict the outcome when various stakeholders' rights come into conflict. That's very important to us, especially you mentioned our business in distressed debt investing. That's very important if you're going to buy distressed credits to be able to predict how we'll be treated by the law. On the other hand, from time to time, other parts of the world offer better bargains. We have the best in the U.S., but the best usually doesn't come cheap. So, and on the third hand, we like to have some diversity in our portfolio. So, you know, we've been investing in places like China and India in the last couple of years, and absolutely will continue to do so. When I hear people say, you know, I've made my living for the last 50 years investing in the things other people said were uninvestable, high-yield bonds, distressed debt, emerging markets in '98, et cetera. And when I hear people say that China's uninvestable, to me, uninvestable says maybe there are some bargains there if everybody else is boycotting that sector.
How fully invested are you? Are you always fully invested?
We strive to be fully invested. Again, we're not market timers. Market timers say, well, right now we want 20% cash. We strive to be fully invested. Our clients hire us to invest in our asset class, not to time the market. And again, if better bargains arise, I'm always confident that we'll be able to raise more money to take advantage.
About 3 years ago, when we were talking about what prospective returns seemed plausible or realistic on some sort of safe or reliable basis, you said 5 to 5.5%.
You have a good memory.
Where are we now?
I think we can make 7 to 7.5. I mean, I'm not talking, I'm saying an institutional portfolio. At that time, I was talking for the Metropolitan Museum of Art, where I chaired the investment committee, and I talked the expectation down to 5, 5.5, as you say. Or I think we came out at, I think the committee as a whole came out at 6. Today, I think an institution like the Met or another pension fund, endowment, et cetera, can make 7, 7.5. Of course, you have to be willing to go into alternatives to do it, but most people are willing.
What kind of alternatives?
You know, the big classes are private equity, private debt. Then there's distressed debt, there's real estate, and specialized forms of investing. The important thing is not which sectors. The important thing is which manager. You know, in the public asset classes like stocks and bonds, we call them beta markets because most of the return is determined by the performance of the market. And which manager you have means a little plus or a little minus. In the alternative markets, there isn't that gravitational pull toward the market return. There's no really market to pace it. What really matters is whether your manager is highly skilled and disciplined or not. And that's why we call them alpha markets, skill markets.
Do you think that your peers are taking undue risk or not enough risk?
Some of each, of course. There's a disparity. You know, there's a range, and all peers do different things. The point is, an area like private lending, where we're very active, has been a darling in the past decade. A lot of money and a lot of managers and a lot of funds have moved into the area. Buffett always puts it best. When the tide goes out, we find out who was swimming without a bathing suit. When economic and financial conditions become more difficult, we find out who made good credit decisions and who made bad ones. We'll see.
What's the historical precedent for this moment? For
this moment? Oh, you know, it's very hard to find one that fits exactly. You know, we've never had this externality of the pandemic. There hasn't been a war going on in a long time, an important international conflict with the threats this embodies. The U.S. never had an economic rival like China before. We've never really had an economic rival since World War II. And of course, we have historically low interest rates. We had interest rates went down by what we call 2,000 basis points. That is to say 20 percentage points from 82 to 22. And that was a big tailwind. So these conditions are are not reminiscent of any that I've lived through. But I think the important thing for your purposes and hopefully your audience's purposes is that I think that our taken as a whole, I think conditions are fairly normal today in terms of how you should manage your money and the risks you should take. And to me, that's the key decision.
Howard, thank you so much for taking the time. Howard Marks, the co-chair and co-founder of Oak Tree Capital. Tom, honestly, fascinating to hear how much some of the pessimism of today that we hear from so many people translates, frankly, into more optimism than a long time, simply because there finally is yield. There finally are opportunities, and finally there is not some monolith of optimism out there.
It's really old school, but it's also old school with a superb excess return over the years. And what's so interesting there, Lisa, with your conversation with Mr. Marks is the idea of a lifting up of the actuarial assumption. This is the Metropolitan Museum of Art. And Lisa, I'm not there yet. If you have a 5% assumption, when do you tick it up to a 7% return? Howard Marks is the first person I heard that from.
And it's frankly when you're starting to see that as the average yield on a lot of these instruments. So if you lock it in, if you believe that these companies are not going to default, if you believe, and you can get into the whole idea of whether the Federal Reserve has killed the credit cycle and whether we're not going to get the same slew of defaults in the same kind of way, this is what more people on the edges are talking about.
That's what Deborah Cunningham said at Federated as well, pushing against Ray Dalio. And she makes clear cash is not trash, and even at the short-term view where she is basically full faith in credit, there's finally some value there, and that's something Howard Marks or any of us haven't seen in, I'll say, 15 years.
Yeah, suddenly, perhaps this isn't the end of a bond bull market, but if it is that actually really positive for bond investors?
Well, you pull back and you go price down and yield up. This is a huge topic at Davos. There's a point, where do you step in? It's no different than the courage to step into equities.
Yeah, honestly, especially when you do the credit analysis. We're getting a nice lift. That's what John says. Yeah. A nice lift to equities. I think it's interesting, especially given the uncertainty and yields higher, that there can be that sustained gain.
And the VIX, 25.94. Please stay with us through the day on radio and television. This is Bloomberg.
It was Bramo that called it a nice lift. Not me, it's a nice lift, according to Lisa, up about 0.4% from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Goodbye, May. Hello, June.
If we look at the performance in May,
we're clearly in a bear market. We've seen a nice little rally.
It's important to listen to what the market's telling.
We're not in the all clear here at all.
The losses this year have been the biggest on record.
We now find ourselves in a little bit more no man's land.
This is not a time when you try to chase and call a bottom, call a peak, call an inflection point.
You look to June.
We could see quite a bit more downside in equity.
Let's get the conversation started with Neuberger Berman's Ashok Bhatia and Cameron Dawson of New Edge Wealth. Cameron, first to you. Hello, June, and hello, QT. How much of a difference is that going to make?
Well, I think it really remains to be seen, because what is very uncertain is how much of the higher bond yields we've seen year to date is in anticipation of QT versus the actual action of it. We start today. We think that the Fed has left the door open to be able to accelerate the movement to the full $95 billion a month. But we really don't know how QT will affect this bond market, if we'll see a really big push in longer end yields. And so I think we'll have to watch that closely, because if yields start to roll over and yet we're still doing QT, what is the bond market saying about growth? And I think that's where risk assets could find another challenge.
Ashok, any lessons at all from 2018 in that period when it comes to QT?
Yeah, I think for QT this time around, the Fed has obviously well telegraphed that, as well as the hiking cycle. So, the Fed will be taking down its balance sheet by, it's going to be about an annual rate of over $1 trillion a year. Really starts in the fall in September. So, our sense is that that balance sheet unwind, a lot of the spread widening we've seen in various asset classes, and partially the rise in rates is just anticipation for that. So, our sense is it's closer to fully priced than unpriced.
Ashok, do you have confidence as to whether it is positive for treasuries or negative for treasuries based on what we have seen?
I think for treasuries, it's going to be, more or less irrelevant. Our main view is this first half of the year for bonds has really been about rhetoric. It's been about the Fed wanting to reset the hiking expectations, which they've obviously done pretty successfully. But we're now entering a transition zone. In the second half of this year, particularly the next few months, we're going to be much more driven by the data. If we see, as we expect, weakening on the job front, weakening on the inflation front, rates and credit are going to find some footing at these levels. But it's really about entering a more of a data-driven market than a rhetoric-driven market. And in that sense, if the data cooperates, I think QT and such will sort of move to the background pretty quickly.
This is what Citi said this morning. They said yields haven't peaked, equities haven't bottomed. They went on to say, despite signs that upside inflation momentum may be slowing, yields tend to not peak until well after inflation has peaked, especially when the starting point of the inflation peak is so high. Cameron, your thoughts on that quote there, your reaction to it, do you agree?
I do agree, because I think that even if we see the headline or the core number peak on a year-over-year basis because of base effects or tough comps from last year, the reality is that inflation is so broad now. Back last year, only 20% of the components in the CPI were above 4%. Now that's 80%. So even if a couple things start to roll over and bring that headline number down, the reality is that inflation is so broad, and the Fed looks at that. They look at something called the trimmed mean CPI. It throws out the extreme readings on the top end and the bottom end, and that remains very elevated at a 40-year high. So even if we see those headline numbers roll over, it really isn't enough to warrant a full dovish pivot by the Fed, because the labor market still remains so tight. It might be softening or easing some, but we're coming off of record tightness. Powell called it an unhealthily tight job market at the beginning of this year. So some easing really isn't enough to warrant a dovish pivot.
The high of the year, 320 on a 10-year in early May. Ashok, the degree of confidence you have that that might be the high of the year for the rest of the year?
Yeah, we're putting that at about sort of 70% odds. So I think it's better than even that this and sort of call it the 280 to 320 range is where bonds are going to find a footing. And, the view on that, you mentioned the Citi quote. I mean, we're a little bit more optimistic that we'll see a little bit faster decline in inflation. Certainly, it's going to still be elevated. We'll see a little bit more weakness in wages. We're already starting to see that. So the macro environment we see is probably a little bit more supportive for fixed income than maybe consensus here right now. There is a chance, right? I mean, inflation, there's a lot of risks associated with it, and specifically on the commodity front. So I think there's, 1 in 3 type of chance that we're going to see something maybe around 350. But, we've been putting cash to work in these markets and various asset classes in this broad range and in 10-year notes.
We'll talk about where you've been putting cash to work more specifically in just a moment. 25 minutes out from the opening bell, futures are positive by about 0.4% on the S&P. Katie Lyons, looking back on May, I have to say it didn't feel like a flat market, but on the S&P, that's what we got.
Yeah, literally almost exactly unchanged on the month of May, even in spite of all of the volatility we saw over the course of the month, John. A whole lot of drama to go basically nowhere. The question now is, where are we going to go in June? Because as you were just discussing, finally the start of QT, persistent growth and inflation concerns, a war still raging in Ukraine, fueling those. Not a great cocktail heading into a month that historically isn't great for the equity market. On average, since the year 2000, June has brought with it a decline of about 0.4% on the S&P 500, the third worst month out of the year. And we have to consider how far we've already fallen coming into this month. The S&P 500 down about 13% year to date, its worst start to a year since 1970. And looking back at starts that rough over the course of history, 4 out of the past times we've seen losses of that size by this point in the year saw the index end the year lower. Interestingly, the one exception was in 1970, but even then, it only closed higher by about 0.1%. And of course, back in 1970 and the years following it, we know that there was a pretty sizable inflation problem in the U.S. economy. We are facing an inflation problem in this moment as well, and in part that stems from higher commodity prices like oil driving up gas prices at the pump for American consumers. And that potentially is poised to get worse, with inventories at 50% of normal levels, and they tend to fall in the summer driving season as it is. So that could mean more price pressure on consumers who may start to change their behavior, become less tolerant of higher prices. That raises the question of the ability of companies to exercise pricing power to retain profit. That comes back to earnings and the fate of this equity market, John.
A lot of drama on the road to nowhere. Kayleigh, thank you for that. Thank you very much. Ashok, just to come to you on that, your view on where you are comfortable taking risks. You touched on it briefly. Talk me through it.
So I think there's two broad areas. First is, high quality fixed income. I think, one of the underreported stories, in this environment has been, 4% types of yields, which for a lot of global bond investors is an important bogey. For the last few years, there was no way to achieve that without non-investment grade and emerging markets and bank loans. Well, suddenly with the rise in rates and widening spreads, things like agency mortgages, investment grade credit, short and intermediate term is offering those yields and more. So we've been deploying capital into those high quality fixed income markets like those two. And then the second area is the non-investment grade market. The non-investment grade market is moving up in quality, and suddenly we find ourselves in an environment with the backup in interest rates where, double B, some triple B securities, 60 to 80 cents sort of price, dollar prices. That type of low dollar price credit instrument is the second area that we like right now. And, yields on offer there are anywhere from, 6 to 8.5%.
Cameron, from your perspective, how competitive is fixed income now? Pockets of it with the equity market.
I think it's far more competitive, mostly if you are a longer term investor and can lock in those yields. The thing that's interesting is that despite the fact that we have seen near term inflation, we haven't seen those long term inflation expectations blow out, which means that the fixed income market still rather believes that inflation will get back towards the Fed's 2% target. So it'll be interesting as we go into the Jackson Hole period how the Fed talks about that 2% target, because that could be the one risk for fixed income looking forward, is that if the Fed starts to move away from that, do we see those long-term inflation expectations actually need to move higher, because they do surprisingly remain anchored.
We keep hearing about it, don't we? This idea of a September reset. I'll go through the dates for you. Fed meetings on the 15th of June, July 27, September 21. Before we get to September 21, you've got a CPI reading next week, June 10th, July 13th, August 10th, September 13th. 4 CPI readings going into that September 21 Fed meeting. Ashok, to you on that. I want your view on it. How you think we reassess things at this Federal Reserve in September? Because there is this conversation fueled by President Bostic last week that perhaps they can pause after doing 50, then 50 again, then pause. Do you agree with that?
I think there's a decent chance we get that. I mean, we certainly think, Fed going 50 at the next couple of meetings, that should be base case, largely priced. But by the time we get to September, we're going to have three months plus more of data, and we're just all going to have a much better sense of how quickly inflation's moving off and what's going on with the labor market. And our best guess is that the data will essentially bail out the Fed, and by September, they'll be able to slow, elongate a hiking cycle, potentially pause. But it's really going to be, to state the obvious, driven by the data. But our sense is the data will give the Fed wiggle room to be thinking about a pause or a moderation in the hiking by the fall.
We'll keep talking about it. Ashok sticking with us alongside Cameron Dawson. Your market looks like this. Equities up about 20. No drama here. Up about 0.5% with your movers. Here's Abby.
Well, John, we certainly do have a nice bullish tilt here for U.S. futures. And one of the stocks helping out, Salesforce.com. Shares are soaring. This, of course, after the company put up a strong quarter. They also raised the full year profit outlook. Solid demand for business software remains in place. And JP Morgan saying that the management tone on the macro is much better than expected. Delta Airlines up about 0.75%, the company following in the footsteps of United Airlines and Southwest Airlines to raise the revenue outlook, saying that the demand is strong even with fares up. And of course, the second quarter adjusted revenue is fully restored restored to 2019 levels. So it's almost as though the pandemic had not existed for Delta Airlines right now. Really pretty impressive. ExxonMobil rising in sympathy with oil back higher again. ExxonMobil up 1.3%. And then Tesla had been down about 0.75% earlier, now down just fractionally. This, of course, as Elon Musk is saying that the return to office, that the employees of Tesla must return to the office or work somewhere else. And I will say New York City, just over the last week or so, John, I don't know if you're seeing this yourself, seems much busier than it had just a couple weeks ago.
You know why they were so frustrated over the last year? You'd see the restaurants downtown New York full at the weekend. Abigail, they'd come into New York for the weekend to be at the nice restaurants and then not come into New York in the weekdays to be in the office.
Yeah, it seems now, based on my look at Grand Central and Park Avenue and Lexington, just folks coming back into the offices finally. Midtown had been very deserted now.
Slowly.
Yes, encouraging.
Slowly. Abby, thank you. Thank you very much. We'll catch up with Ed Ludlow a little bit later on about that line from Elon Musk. We did get some price target cuts from Goldman this morning. I'll go through them later on Ford, on GM, on Tesla too, on two things: additional supply chain troubles in the near term, weaker demand in the intermediate term. We'll talk about that a little bit more a little bit later. Coming up next on this program, President Biden passing the buck on inflation.
My plan is to address inflation. It starts with a simple proposition: respect the Fed. Respect the Fed's independence.
That conversation up next.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
My plan is to address inflation. It starts with a simple proposition: respect the Fed. Respect the Fed's independence. They have a laser focus on addressing inflation, just like I am. And with a larger complement of board members now confirmed, I know we'll use those tools in monetary policy to address the rising prices for the American people.
Over to you, Chair Powell. President Biden passing the buck on inflation. Secretary Yellen issuing a mea culpa.
I was wrong then about the path that inflation would take. As I mentioned, there have been unanticipated and large shocks to the economy that have boosted energy and food prices, and supply bottlenecks that have affected our economy badly that I at the time didn't fully understand.
We need to get to AMH down in D.C. Anne-Marie, credit to Secretary Yellen, stepping up, standing there and saying, I was wrong.
Yeah, a lot of people got it wrong, right? Including the Fed chair, Jay Powell, who the president has now said it is fully his responsibility to fix. Also, yesterday, Jonathan, in the briefing room, after that meeting, Brian Deese, the president's head of the National Economic Council, came out to brief reporters on the meeting on inflation and was asked as well. Said, sir, you stood at this podium telling us this was going to be temporary, and instead of owning it the way Janet Yellen did, really deflected and also pointed a lot of attention to how uncertain this was coming out of a pandemic, but also the fact that this is a global problem. Look at Europe. They're dealing with north of 8% inflation as well. So clearly, Jonathan, you see the administration really coming out aggressively that you're going to see more of this as well for the month of June to pivot towards tackling the issue of the economy. But the question is it so much going to be in different policies or more about the messaging? And so far, it's really been the messaging. The president, 24 hours, 2 op-eds, Wall Street Journal, New York Times. He had a meeting with the Fed chair. He's going to be meeting with suppliers for infant formula. There's going to be a lot of different messaging, and very aggressively so for the month of June, because when you look at the polls, and one recent one said 9 out of 10 of Americans, out of a minimum, say inflation is the biggest concern, and they don't like the way the Biden administration is handling it.
You said it. Let's unpack it piece by piece. We had an op-ed in the Wall Street Journal on inflation. We had an op-ed in the New York Times on foreign policy, a mea culpa from his Treasury Secretary. You can throw in the fact that he sat there with the Fed chair, and not so subtle, it's them, not us, about inflation with the Federal Reserve, and an NBC report in the last 24 hours suggesting this president is increasingly frustrated with his own administration and the people around him. As you pointed out, Anne-Marie, is this going to be about policy or messaging going into the midterms?
Well, at the moment, I think a lot of this is about messaging, right? One of those nuggets in that NBC report, Jonathan, said the president is incredibly frustrated where he comes out and he says something and then only for his own aides to then walk it back. So there does seem that there are a lot of questions around potentially is there going to be any shifts in the administration. The NBC piece talked about potentially with the White House Chief of Staff, Ron Klain, maybe after the midterms. That would be a more traditional path of a lot of presidencies. After 2 years in, after a midterm, sometimes there is a change of course, but it does look like are changing course at the moment ahead of these midterm elections, where this is the #1 issue for voters to change the communication on inflation. When it comes to policies, they say that they are doing everything they can, but then you question, are they? We asked Brian Deese yesterday in that briefing room. Reporters asked him, sir, where are we when it comes to the China tariffs, which some economists say could shave off some inflation? And they said, I don't have an update for you on that. So a number of policies that have been floated, but then they've not actually followed through, that some say could impact the inflation story right now.
Anne-Marie, thank you. Related to this story, the price target cuts that we're seeing over at Goldman on those 3 automakers, Ford, GM, Tesla, this is what they had to say. Supply chain troubles in the near term, weaker demand in the intermediate term. On the demand story, they said key metrics that correlate with auto demand, housing data and consumer sentiment have slowed. The analyst added, PMI metrics like the ISM index and consumer demand data points have also weakened. Ashok, I want to come back to you, and thanks for being patient as we work through some of this. Your thoughts on where the automakers sit now in the credit market for you, given what could be happening with consumer here in America?
Well, from a credit perspective, you know, the automakers are still in good shape. And I think it speaks to, you know, this cycle, COVID hits and companies really, they raised a lot of cash, improved balance sheets, you know, extended maturities. So they entered this year with actually, just as a general statement, stronger balance sheets and better, you know, better looking from a bond perspective than they did 2 years ago. And then, you know, typically we would have seen that cash get used and balance sheets deteriorate. But the events that happened with Russia and Ukraine and the Fed hiking, starting a hiking cycle in March, happened so quickly that companies really never had an opportunity to use that cash on balance sheet. So we're actually very comfortable with where autos and other industries sit from a credit perspective. And a lot of it is the improvements that happened over the last 2 years are still there and will ultimately, I think, stabilize this credit cycle, however it turns out, with lower defaults, lower downgrades than we typically see in a cycle.
Cameron, tell me, how does the same story look from the equity side?
Yeah, I think the equities are really starting to sniff out that there could be some challenge for the consumer because we are seeing demand destruction, or at least early signs of it, for high ticket price, sort of larger purchases, and also those interest rate sensitive parts of the market like housing, like autos. And I think that the reality is that the consumer is finally getting to the point that they're becoming much more stretched. If we look at real wage growth, it's actually been negative since April of 2021, which means that consumers have been losing purchasing power for a year. Now, this wasn't a problem early on because we had child tax credit, we had supplemental unemployment, and we had high savings balances. But now we're at the point where you don't have benefit from the government, you don't have that high savings balances, people are having to spend down, they're turning to credit to bridge the gap between what they want and what they can afford. And the end result is that we're likely to see more belt tightening because of high energy prices, because of high food prices, really eating into the ability for people to spend on discretionary items. And so that was the story from this earnings season as you start seeing the early signs of that belt tightening.
And Cameron, just quickly, do you worry that these supply chain issues will get fixed just as the demand starts to disappear?
Yeah, I used to be a cyclicals analyst, and that always seemed to be the time is that you would see inventory builds right into the peak of the cycle, just as you're starting to see demand start to roll over. So that certainly could be the challenge here. And I think it'll speak to or put pressure on possible pricing power for these companies. Because the problem that we have is that prices are remaining very high, or cost inputs are remaining high. But as demand starts to slow, they lose the ability to pass on those higher costs to their end consumer. And that's where we're seeing margin pressure. So margin pressure, I think, really is the story for the remainder of this year. Because if you look at estimates for EPS growth, a lot of the upside comes from margins going to a record high by the end of this year. And that's likely too optimistic.
There's so many companies caught wrong-footed through this cycle. Cameron, great to catch up with you. Thanks for being with us today. Cameron Dawson there. Ashok Bhatia, thank you to you, sir. Coming up, the morning calls, and later, Morgan Stanley slashing price targets on a number of US tech companies. We'll catch up with BlackRock's John Barvan around the opening bell.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Five minutes from the opening bell, equities doing okay, up 0.6%. That's your price action. Here are your morning calls. The RBC Capital upgrading Danaher to outperform, seeing an opportunity to own a high-quality defensive stock at a reasonable price. Next up, Goldman cutting its price targets on Tesla, Ford and GM, highlighting supply chain headwinds and weaker demand. And finally, Morgan Stanley slashing price targets on a number of tech giants, cautious amid growing signs of an economic slowdown. Coming up, BlackRock also cautious. Jean Bavin saying the equity rally isn't sustainable. That conversation and your opening bell up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We closed out the month of May positive 0.01%. You can't make it up sometimes. The numbers speak for themselves. It did not feel that way, that's for sure. Futures right now positive about 0.6% as we kick off the month of June. On the S&P, on the Nasdaq 100 positive about 0.7%. We kick off the month of June right now. Switch at the board and get to the bond market. We look a little something like this on a 10-year yield. In America, Treasury yields pushing just a little bit higher by half a basis points to, let's call it 285, 284.95, and then we turn to 285. Euro dollar 107.24, negative about 0.1%. Deutsche Bank out with a fascinating call on the ECB. They think in Q3 the ECB goes twice, and one of those moves is a 50 basis point rate hike. We'll touch on that a little bit later in the week. Crude up by almost 2%, 116.89, whipsawed by that Wall Street Journal report from yesterday, suggesting that perhaps OPEC Plus could drop the plus, go negative. Russia ultimately come to their own deal on production, boost production, crude lower. You get the picture. and that's why crude yesterday backed away from 120. I think they had a session 119.98 yesterday. Looking at the open today, up about 0.6%. Information technology top of the pile, up by 1.1%. Materials and financials with some relative underperformance. The financials up by only 0.1%. With more, here's Abby.
John, well, definitely a nice tailwind here for stocks for the start of June, and a piece of it, the airlines. Of course, we have Delta Airlines following in the footsteps of United Airlines and Southwest, raising the revenue outlook. Demand staying strong even with fares up. Americans determined to take their vacations. In fact, they see their second quarter adjusted revenue fully restored to 2019 levels. ExxonMobil up 1.5%, as you were just mentioning, the possibility that OPEC will drop that plus or exempt Russia from its targets. You see oil higher, as you were mentioning, and ExxonMobil going along for the ride, up 1.5%. Salesforce.com really outperforming, up 11.4%. The enterprise software company raised their full-year profit view. Demand for business software solid. And JP Morgan was impressed by the management's tone, saying that their color on the macro stronger than expected. Finally, General Motors, you've been talking about that Goldman cut to price targets. You see General Motors not paying attention. The investors bidding it up 1.6%. They cut the targets, of course, on supply chain and demand risks, but it was a cut to 46 from 59, so a bit of housekeeping, and we will have Ward's auto numbers here in the U.S. for the month of May, looking at 13.7 million autos sold in the month of May here in the U.S., down just slightly from the previous month, John.
Just toning down the optimism on the year ahead over at Goldman on the automakers. Abby, thank you. About 2 minutes into this, we're positive 0.8% on the S&P on the session. On the year, we're down 12.6%. On the NASDAQ on a session up 1.1%. On the year, we're down about 22%. Big tag, very much hoping for a better summer following a rough start to the year. The sector's biggest names, the FANG stocks, racking up some major losses through the month of May. On the West Coast, let's get to Ed for more. Morning, Ed.
Yeah, good morning, John. The FANG stocks have been a focus, and as we sort of head to the midpoint of the year, you look at all corners of the technology sector, and they're not all created equally, right? You look at the NASDAQ 100, the Philadelphia Semiconductor Index, some of those mega cap tech stocks included within those baskets, both down more than 20%. But really, it's the more speculative and risky areas of the market. I look at the Goldman Sachs non-profitable tech index down almost 50%. You look at the names within their higher multiple software stocks, some of the pandemic era winners like Uber also within that basket. I gave a smile at the close last night, John. I enjoyed it. I haven't seen that in my career. Flat in the month of May on the S&P 500. We narrowly avoid the bear market, but we've already seen bear markets in other indices, right? Particularly tech-focused ones. The NASDAQ 100, as you and I have discussed in the last 24 hours, the narrative is building that there's legs to run more on that bear market in big tech. We're in a position now, and I saw this throughout the session on Tuesday, where yields are rising, right? We see this shift to value. Value stocks outperforming growth in a big way, not just in the moment, but over a historic precedent basis as well. The concern that your guests keep raising is, does this change with the inflation picture as it is? How do these non-profitable companies in the tech sector in particular fare?
You know who wants to see a bear market? Elon Musk, working from home. This is what he had to say. You've read this already. I'll share it with our audience who haven't seen it yet. Remote work is no longer acceptable. Musk went on to say anyone who wishes to do remote work must be in the office for a minimum, and I mean minimum, of 40 hours per week or depart Tesla. This is less than we ask of factory workers. Ed, your view on how this is playing out?
That was a very good Elon Musk impersonation, John. Well, look, he's been consistent throughout from the early days of the pandemic, right? He fought very hard to keep Fremont over the water from where I'm sitting open. At this time, they're moving mountains to keep Shanghai running amidst those Shanghai COVID restrictions, which are now easing. The biggest line for me in that quote in the memo was, he will personally approve any exceptions to the rule. And last I checked, Tesla had more than 100,000 employees worldwide. So you can imagine how busy his inbox is going to be over the next 5 days.
I think that's going to be filling up pretty quickly. I just wonder how Twitter is feeling, Gad. Can you imagine the tech world of Twitter, of Elon Musk, if he does get his hands on it?
Yeah, look, Twitter, internally, employees are discussing this day in and day out about what the company is going to look like, about the culture of the company. They're referencing recent reporting and allegations against Elon Musk around sexual harassment. We have some reporting coming later on the Bloomberg terminal about some of the product changes that may be changing at Twitter, right, with a view to what Elon Musk might be focused on. But internally, for these employees and these software engineers, it's still a great unknown.
Ed, looking forward to your reporting a little bit later. Thank you, buddy. as always. The pain of big tech, then, may be far from over. That's the view from the team over at Morgan Stanley, slashing their price targets on Amazon, Alphabet and Meta amid growing signs of an economic slowdown. Back with us for more. Here's Katie.
Yeah, John, Brian Nowak and his team saying that the odds of a recession here in the U.S. are now up to about 35%, up from about 5% at the start of the year. And they say that could spell bad things for advertising and e-commerce growth, which is a bad thing for a number of these tech names. They slashed their expectations for online ads and e-commerce growth by about 1 to 4% for 2022 and 2023. And also, as you said, sizable price target cuts for the likes of Snap and Pinterest. Snap's target cut 56% down to $24 a share. The cut for Pinterest was about 25% down to $21. And you also had some sizable cuts for the larger players as well. Now, to some degree, this is a game of catch up because as Ed just ran us through, these stocks have already seen a lot of pain so far this year, all of them down 20% or more. And that has knocked trillions of dollars in value off this equity market and dragged the NASDAQ 100 into a bear market. Global tech more broadly heading for its worst annual performance in 14 years, since all the way back in 2008. Obviously, though, these stocks are now much cheaper. The forward PE multiple on the NASDAQ 100 is now about 21. That is the third below its height in 2020 and below the 5-year average of 23. So these stocks are cheaper. Valuations maybe look more attractive for dip buyers. The question is, how many people want to dip their toes in this water with all the headwinds still out there, John?
Kelly, thank you. Seemingly some today, at least. On the S&P 500, up 0.8%. On the NASDAQ, up by 1.2%. Just yesterday, we caught up with Savita Subramaniam of Bank of America. Take a listen to this.
Maybe we're not at the absolute bottom, but there are some areas within the equity market that are likely to be, some of the best opportunities, some of the best entry points that we'll see in this sell-off. So equities offer inflation protection and cash return. Where can you get those things? Well, a lot of equities have them: energy, financials, even healthcare staples.
Let's get the BlackRock view from John Bavan. John, great to have you with us on the program. You've toned down your view on equities recently. Just walk me through the thinking.
Great to be with you, John, this morning. Thanks a lot. Yeah, so the main, it's all about the policy landscape and the Fed in particular, I would say. We have been, overweight equity by a lot of the arguments we've just heard about. Equities are attractive in an inflationary environment and will continue to be, but there's been a significant repricing of the policy path in the U.S. Over the course of the last few months. Very significant. We don't think that ultimately that policy hiking will be fully delivered. But for the time being, the Fed is really playing for the inflation, politics of inflation. And until that changes, I think we're going to be in an environment where, it's difficult to see, a buy the dip mentality working out. I think we're gone the days of just simply buying the dip. It's a different kind of environment. And so we'll need to have clearer signals on how the Fed is framing this environment before we see, a more constructive rate landscapes supporting equities.
Jean, you were previously overweight. There might be some people, they might be rude, they might turn around and tell you this is like closing the barn door where the horse is already about 2,000 miles down the road. What would you say back to him, Jean?
Well, I mean, I think we're adjusting to a pretty significant backdrop that has changed in terms of the rate side of things. I would say, our biggest conviction underweight was on fixed income government debt, which we thought like yields will have to go up. We still believe they have to go up from here. So that has played out, partly in the long end where we think that has more to continue. There's been more noise now on the Fed front, and we're acknowledging this. We think ultimately central banks will have to pivot to a more dovish stance. And as a result, we will see eventually like a more constructive environment. But right now, we think like it's better to be neutral. I mean, just to be clear, we're falling back to neutral, staying invested, but neutral. And we think they're going to be better entry points, still over the next few months until we get clarity.
On the central bank story, here's the quote on the Fed from you and the team. You said the path of short-term rates is less than what the market is pricing in now. That's what you expect. On the ECB, you say we see the path of market pricing too aggressive. You see that both at the Fed and the ECB as well. You mentioned there that they might have to pivot. So let's talk about that, Jean. What's going to trigger that move? What's in the path forward, in your view, that you think triggers that move?
Well, I think it's important to maybe take a little step back to see why we think of this way going forward. But like last year, we had commentators and the Fed, I think, central banks in general, oversimplifying the story of inflation with framing it around like a time frame, right? Which was like temporary, which we don't use anymore. That turned out to be wrong, could not be sustainable as a story, so we shifted away from that. But unfortunately, I think we've shifted to an oversimplified story again, which is one where we're going to raise rate until inflation is under control. But that's trivializing the world we're in. The cost of bringing inflation quickly back to 2 would be extremely acute, high, and I think that's going to become clear over the next few weeks and months. And as this becomes clearer, I think there will be no choice but to acknowledge a trade-off that is not as simple as simply raising rates until inflation is tamed. So that's the trigger, is like acknowledging these costs, which will be pretty real and will come clear over the next few weeks.
So, Jean, this is really, really important. Fading the tightening story at the Fed isn't necessarily good news. It can mean inflation is coming down because the supply side surprises in a positive way, or it can just mean the economy can't handle it. So, Jean, just be more specific for us. Which one is it, and what implications does that have for how you allocate capital?
So we don't think there's a nice Goldilocks scenarios in the middle, which I think is what you're getting at. I think either we're getting a world where we're slamming the brakes, we're insisting on getting inflation back to 2, which I think is a world where we're going to see a recession. I don't see any homegrown reason or endogenous reasons for a recession to happen. It's not a typical recovery that leads to a recession, but if the risk of over tightening could be leading us there. The alternative, which is what we think is going to be ultimately the most likely scenario, is we're going to live with somewhat more inflation. So it's not a great scenario. It's not like a Goldilocks like we might have seen over the last 20, 40 years, but it's one that I think is more benign than a recession one. And that's why we expect a bit more inflation than the market is expecting. We see rates going not as far up ultimately, but at the same time, lower cost in terms of economic activity.
So, Jean, coming into this year, my thoughts on fighting the Fed. A lot of people would say, don't fight the Fed. And I had to think about, well, what does that mean for 2022? And what I thought it meant would be inflation protection would no longer be needed because this Fed doesn't want inflation anymore, and ultimately means higher real rates. Are you saying we can fight the Fed? We can fight that effort because ultimately they won't be able to succeed without causing a recession?
Pretty much, that's what I think we're saying here, is that it's going to be very difficult to tame this inflation, bring it back to connection lost. And it's not something that is caused by, a monetary policy itself. Interest rates themselves are not really addressing the root cause of what we're dealing with right now. Massive reallocation shock between goods and services, the biggest we've ever seen in terms of sectoral reallocation. That won't be solved by tightening policy. I think that's going to become clear. And if we try to do it, it's going to be extremely costly. And so I think that's what, don't fight the Fed or fight the Fed, I don't know, but it means not buying the idea that inflation will fall back quickly to 2% and connecting that to rates rapidly increasing.
Jean Bavin of BlackRock. Jean, stick with us. We've got some data out in just a couple of minutes, and Mike McKee's going to drop by and break it down for us. Jean, thank you. We are positive by about 0.5% on the S&P 500, on the NASDAQ higher by about 1 percentage point. Coming up just around the corner, jobs day in America and a ton of economic data.
The Fed's pretty convinced that they need to go to something close to neutral, and expeditiously is the way that they put it. And so that's what they're doing. I think that the economy is going to have enough momentum to keep the Fed so the Fed will keep going into the fall.
That conversation up next.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Fed's pretty convinced that they need to go to something close to neutral and, expeditiously is the way that they put it. And so that's what they're doing. The notion that at some point they're going to take a pause and look around, of course that's going to happen at some point, but it's going to be driven by the economic data. I think that the economy is going to have enough momentum to keep the Fed will keep going into the fall.
Bill Dudley there, the former New York Fed president. On the economic data, let's get to Mike McKee. Morning, Mike.
Good morning, John. Some fresh data coming in from S&P Global. Its U.S. manufacturing PMI out. And as is the case around the world today, it's basically a story of stabilization with the number coming in at 57, down from 57.5. However, a little bit less than the market thought, but it doesn't really matter all that much. It's a kind of a rounding error in this case. And it does suggest that the manufacturing business has stabilized. Of course, top of the hour, we'll get the ISM number, and that'll get a lot more market attention. But around the world, same story. We've had some slight changes in the manufacturing ISMs for Germany, France, Italy, the Eurozone, and the Euro-K. Some up, some down a little bit, but all still in the 50s, all still suggesting manufacturing is expanding around the world, and that's what the central banks want to see as they are raising rates. Rest of the week is going to be interesting. Here are the most important things that we're watching. The ISM, as I mentioned, we'll also look at the prices paid as part of that. Auto sales are those starting to be affected by higher interest rates. Jobless claims, everybody's canary in the coal mine. And then, of course, Friday is Jobs Day and ISM services. I mentioned at the bottom there, the Fed balance sheet. This is June. We're starting the balance sheet reduction this month. Doesn't really start until the 15th when the first bonds start to roll off, but people are going to be watching. Nothing's going to really happen or change in the markets, John, for some months because we're talking such huge amounts of money, but it does begin this month.
It's finally here, and you asked the chairman himself for the news conference, why did we wait so long, but we can go there another day. Mike, JOLTS data, it's taken on this new importance. What do you make of that?
Oh, it's just people trying to figure out where the Fed is going. And the Fed is, we know, going 50 in June and July, they say, unless they come out and change their mind. So then what happens after that? And there's a feeling that the jobs data will help them make a decision because, as Bill Dudley was pointing out, the Fed is probably going to be pushing the unemployment rate up. It's been going down. It's forecast to go down again. So when do we start to see a change in the employment situation because interest rates are higher? That will give the Fed a clue as to how their medicine is working.
Mike McKee, thank you, buddy. As always, going through the data, the PMI behind us, ISM coming out in about 10 minutes. You get JOLTS data, job openings in America as well. On to tomorrow, we get ADP, jobless claims. I think we get some factory orders, durable goods, capital goods orders in the mix as well. They're onto payrolls Friday. Jean Bavin waiting patiently for us. John, thank you for that. Let's frame the debate with the Fed. And we know your view now. You've got the one side of the conversation, the debate, the argument that the Fed is going to keep on going. Think Bill Dudley. He thinks the economy is resilient. They'll have to do more. Your view, the Fed takes a pause. I often think about this, often ask this question. How and when would you know if you're wrong? Where on the calendar can you identify when this argument gets settled one way or the other, Jean? Where is it?
I think they're going to 2.5 or close to that level by the end of the year. We'll see. We'll get a better sense as we get closer whether like this is close to what we think is neutral. We've already seen like a pretty sensitive market to this repricing of rate hikes. So I think this is a sign that like we'll get more and more evidence that like neutral might be, you know, not that high in this cycle. But I think by the year end, we'll get to that point where the Fed has framed things around two phases. We're going to try to go back to neutral swiftly and then reevaluate. And that's going to be then a question about what we do next. And I think this is coming into sharper relief, you know, by the year end. And so that's the horizon we're looking at. Getting close to neutral as quickly as possible. I think that's a kind of a 2.5 number that we are looking at. And once we're at that number, reevaluate.
Jean, just to lead on your central bank experience, as you know, it's impossible to know where neutral is in real time. Monetary policy operates with long variable lags. You know that quote, we use it all the time. John, how do we know any of this stuff where neutral is, and ultimately, do we find out too late? And if it's too late, we've already made a mistake, haven't we?
Well, I think one of the things I find a bit troubling in this environment is that we've completely lost this story about being forward-looking when it comes to central bank. All of the communication is kind of backward-looking. We've talked about like, you know, framing things like we're going to hike until inflation is tamed. That's an example, right? Where by the time we know that, it's going to be too late. We're going to have overdone it. So there's a bit of a worry here of being in the mode of backward-looking policy making, and I think also solving for politics. I think where the politics of inflation is really like the driver here. And there's a bit of a rear view mirror here, story that is at play. But I do think that we won't never know whether we're at neutral, but we'll see sign of pressure cracks that I think will be more apparent, and they'll start to build a narrative around that, and we'll see some part of the committee making these arguments more forcefully as we get closer to the end of the year.
We've got to leave it there. Great to catch up, as always. Jean Bavin, there of BlackRock. We saw the politics of inflation on full display in the last day or so. Your equity market's positive by 0.5%. Your trading diary is up next.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
26 minutes in, stocks are higher. Here's your trading diary. ISM manufacturing numbers coming up at the top of the hour. Some Fed speak from President Williams and Bullard following the Fed beige book a little bit later. President Biden meeting with baby formula manufacturers at 2:45. Another round of jobless claims on Thursday, and rounding out the week with a big one, the payrolls report. Job openings a little bit later too. Ton of data this week from New York City. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospitalized due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Vinergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Vinergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Vinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Vinergold as an opportunity to leave that troubled home. Vinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Vinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Vinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Vinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most